Honorable Michelle Lujan Grisham. Honorable Stephanie Garcia Richards.
Here.
Honorable Laura Montoya.
Good morning, present.
Secretary Cross. Here. Tim Jennings. Errol Lavender. I'm here. Kurt Summer.
Here.
Mike Messina. Nick Thayer.
Present.
Catherine Allen.
Present.
And John Benson. Present. Madam Chair, you have a quorum.
Let's move on to agenda item 1B, approval of the agenda.
So move. I move approval.
Got a motion by Member Lavender, second by Secretary. Any discussion on the motion to approve the agenda? I'm going to take a roll call vote on that motion.
Governor Michelle Lujan Grisham. Commissioner Stephanie Garcia Richards.
Yes.
Treasurer Laura Montoya.
Yes.
Secretary Cross. Yes. Nick Thayer.
Yes.
Catherine Allen.
Yes.
John Benjamin. Yes. Tim Jennings. Errol Lavender. Yes. Mike Messina. And Kurt Summer.
Yes.
Madam Chair, that passes 7 to 2. Or I'm sorry, you have, that does pass. It's hard to count.
All right, so we're going to move on to agenda item 1C, approval of the SIC minutes from June.
So moved. Second. Commissioner Garcia Richards. Yes. Treasurer Laura Montoya. Secretary Cross. Yes. Mr. Thayer.
Yes.
Ms. Allen.
Yes.
John Bingham.
Yeah.
Mr. Lavender. Yes. Mr. Messina. Mr. Summer.
Yes.
Let's go back to the treasurer.
Treasurer Montoya.
Yes.
Thankfully, you are at 8-0.
And then finally, we have approval of the SIC minutes from July.
So moved. Second. Commissioner Garcia Richards.
Yes.
Treasurer Montoya.
Yes.
Secretary Cross. Yes. Mr. Thayer.
Yes.
Ms. Allen.
Yes.
Mr. Benjamin. Yes. Mr. Lavender. Yes. Messina.
Yes.
Mr. Summer.
Yes.
So 9-0.
Okay.
Madam Chair.
All right. So let's move on now to agenda item 2A, and we'll turn it over to Mr. Ruiz, our state investment.
Thank you, Commissioner. Good morning, everyone. As we traditionally do, let's focus on the briefing page that you have been sent, or you should have with you. Items A, 1, 2, and 3. Total distributions for the last 12 months have been $1,629,000,000 rounded. Total land grant permanent fund contributions from the state land office, $179,669,000 rounded. And as we all know, that does have a 90-day lag. Net asset value as of Friday, and we have not seen it, at least I have not as of this morning, I don't think it's changed much, was $44,074,000,000 rounded. New Mexico WTI oil price as of Friday was $78.52 per barrel. A year ago, that was $95.89 per barrel. Rig count, this is interesting. As of a year ago, 106. As of Friday, 107. Natural gas price, a year ago was $9.47 per MCF. As of Friday, it was $2.55 per MCF. Interesting numbers. I would like you to please focus on item C. Just to remind everyone, the investment committee will meet next month on the 19th of September, 1:30 in the afternoon at our office. Council meeting September 26th, right here, same time. Operations, and I've added 2 or 3 things that are not on what you received, just to update a little bit more thoroughly. We are currently attempting to hire, we're sourcing an analyst for our real estate, real return portfolio. We're looking for another investment strategist. In the future, we will be looking for an investment operations person and a private equity analyst. Governance Committee today will be reporting on the ongoing state investment officer search. So Kathy, as chair of that committee, would you kindly give us an update? And you are on mute.
Sorry, I'm driving a car also from a meeting. We have a description now that has been sent to us, and the committee is looking at that, making comments on it. All of the council members and all of the senior management staff were interviewed to be have input into the description. I will be sharing that with the rest of the council as soon as I get the comments back from the other committee members. And then we will be out, that will go through the various media that is used to recruit CEOs. If any of you have names, again, all names or resumes should go to the Hudapol company, the search firm that is helping us with this. So we're ready to go out to start looking, and we already have received or have some resumes. So that's all I have to report right now, but you will be getting a copy of the description, final description in the next couple of days. Any questions?
Is there any questions for Kathy?
Questions from council? Thank you, Madam Chair.
Under item E, external relations, never quite sure where to put certain things, so we'll talk about 3 different things. We presented to the City Different Petroleum Club on the 24th. That's an interesting group made up of former oil and gas executives and other members of the public that are just interested and who like to attend those meetings. We had a very good turnout. Charlie, if we send the slides to the council?
We didn't, but we can.
Fine, we'll send you the slides. It was an update on things that we had mentioned to them previously, and we added several new interesting things, and I think you might like to see those. We met with the Investments and Pensions Oversight Committee, IPOC, on July 26th, as well as August 18th, and both of those meetings went well. And on the 13th of September, as I mentioned to you previously, we will be hosting the other sovereign wealth funds in the U.S. For a day-long meeting here in Santa Fe. Madam Chair, that concludes my remarks.
Any questions? Hearing none, we'll move on to agenda item 2.
Well, thank you, Madam Chair. Just a ton going on the global macro side. She's just keeping us busy. China's economy's hit a rough patch. You've probably seen the terrible stories in the newspaper. I mean, collapse type numbers in exports, minus 25%. Same thing on imports, nearly 25% there. Debt problems are starting to raise their head in the property markets there. So a real big cyclical downswing in China. We actually have a whole presentation on China we just put together. In fact, it's up on the legislative website. If you go to webcast there and look up the last IPOC meeting, we're first off to bat, and a lot of that's on China and some of the long-term demographic problems they're facing, some of the medium-term deglobalization problems that they're facing, as well as this recent cyclical downswing. Or give us a call, we'll set a meeting up, walk through the report. Let's see. Europe also appears to be in recession now. Germany in particular is just being pressured, and that's the primary major economy in Europe. So we're keeping our eye there. Here in the States, we've actually got a little stronger economy than we were expecting. We thought we'd be in recession by now. We're not. And some economists are starting to come off of that call. I think it was something, I don't know, 70 or 80% of economists were saying recession in the U.S. in 2023 at the beginning of the year. Haven't had it, so it's dropping. A number of people calling for it. We just still think that, you know, the Fed created an interest rate shock in our economy here by raising rates as far as they did over the last year and a half, roughly. That there's just a shoe to drop. We've seen no bank failures except the four banks that failed in California or Silicon Bank related banks. But that was a very specific depositor base, a very specific type of bank. We haven't seen a big general bank failure here. The housing market is coming off here in the United States, really, really slowing down. That's usually one of the first sectors of the economy to take a hit when interest rates get raised. But still a lot of strength. I think part of it is there's still a lot of liquidity in the economy, and another part is the millennial generation is still in the back end of that generation is still in their high spending years, and we think to a degree the millennials are holding things together here in the U.S. So a little stronger here. You know, we really like our position. Thank goodness cash rates are 5+% because we've got just a ton of cash that's come in, $8 billion last year in 2022, and you know, billions again this year. And so getting that invested in the private asset markets takes some time. So we've got big cash balances, but we're in a little over 5% on it. So it certainly hurts a lot less than it would if interest rates, you know, two years ago or so when they were zero. Really what causes problems today we don't have to face. So that's kind of it. There's just a ton going on geopolitically and all that stuff that affects us, but we don't need to run through that. Administratively, Steve announced we're still looking for some folks. Real estate real return analyst, that'll be back up on SPO's website. That expired, so we'll get that back up on SPO's website as well as our own, and still beating the bushes for somebody there. It's been pretty long running, and we're going to have to redouble efforts to get that spot filled. I think we've got a strategist position open. That'll be up on SPO's website. It's also classified as well as ours. And then, I'm sorry to announce, but Starla Bennett's going to leave us at the end of September. Starla's been with us since 2007, did we agree yesterday?
Yeah.
And she's been our asset class director since 2013, right? Yep, okay. Got the numbers right there. So that's going to leave us a big hole at the asset class director level. That job's exempt, so that'll be up on our website, and on the CFA website. So we'll be actively recruiting here, you know, certainly by the end of the week. We should have things going. So those three positions Steve mentioned, we're intending on approaching you all, and then further with your approval, the legislature for some new positions on the investment team. You know, we're still 13. That's what we were in 2010 with, you know, with $13 billion. Now we're 45 billion headed to 100. We need to do something in the near term here. So we'll be approaching it before the budget goes in, Brett's budget goes in, and then we'll be, with your approval, talking with the legislature about expanding the investment team and maybe some other places in the office if Brett determines he needs. But Madam Chair, I think that's it. Happy to answer any questions or talk about anything you want to talk about.
I think now might be the time, Madam Chair. It's interesting, I think Vince's comment about the fact that we're not in recession, even though 6 months ago it really looked like we were going to be. What's really, I think is really impressive is the fact that we didn't position ourselves to be in a recession so that at the expense of keeping everything kind of status quo. And I think that Vince and his team have done a great job of keeping us pretty level as far as the kinds of investments we could have made if we had really believed that there was going to be a recession, which I think Vince may be off a little, about 90% of the people with whom I come in contact and with whom at whom I take a look were saying recession. So I think that's pretty good testimony to the staff.
Okay, so hearing no further questions, we will go to agenda item 2C. You're going to present from there.
So, thank you, Madam Chair. Do you have any comments?
I don't know. Listen, right away for you guys.
Okay,
Yep.
yeah. And thanks for the introductory comments on the economy. Today we do have the executive summary through the second quarter of this year in your packet. As always, I'll start you off with a little bit of an overview of the capital markets and how the asset classes performed. Hopefully that will frame up the performance for the various funds that we'll then spend time talking through. I would turn you to page 3 of the executive summary. I think that's page 22 of the packet. Provides the one-page overview of all the major market indicators and asset class stats. And I think when we get to that page, or if you're following along in your own packet, on the bottom left, you can see the market performance.
Madam Chair, can we put a microphone by him?
Oh, absolutely.
Thank you.
Is this better in terms of audio pickup? Okay, thumbs up. Perfect. Very good. Yeah, I was just mentioning, bottom left-hand table shows the market performance for the various major asset classes, and that first column provides the quarter, the second quarter, followed by the calendar year to date, so essentially the first 6 months, and then the trailing period thereafter. I think you can see as you're looking down that first column for the quarter that it was quite positive for really all but the most interest rate sensitive asset classes, and that's probably not terribly surprising given what has been happening to rates. So those would be core fixed income, real estate, some of the assets that we've been talking about that would come under pressure if interest rates come up. And we've really seen that theme extend for much of this year. But all the other asset classes, I think, surprised to the upside, as Vince said, particularly domestically. The S&P 500 is up 17% or so for the first half of the year, and that actually extended to 21% through July. Now August gave some of that back, so we're about the same place where we ended the second quarter. But I think it's certainly surprised to the upside here so far this year with all the calls for a recession that I think were pretty widespread at that point. The performance, particularly for U.S. large cap, and I think we've mentioned this in the past, has been pretty narrow in terms of market leadership. There's really just a handful of names, particularly the largest names in the index that have been driving that performance. 7 largest or so have been up north of 80% for the first half of the year, and really all the other stocks in the index are low single digits. So it was very bifurcated in terms of where that return has been coming from. Some of that has moderated as we've moved into the second half of this year. Inflation, we've talked about that pretty extensively over time now. It feels a lot less relevant now that the numbers have dropped to their current level. We were 5% at the end of March. Now June, July are sitting closer to 3%. That feels a lot better than 9% where we were. But we're still above the Fed target of 2%. And Fed just had their annual meeting in Jackson Hole last week, and really there reaffirmed the commitment to the current policy stance. So while they didn't say there was imminent future rate hikes, we could certainly expect some additional movement in rates. And to get some perspective in terms of how rates have moved, you can see on the right-hand side the yield curve at different points in time. Certainly from just a year or two ago, sure, the lines at the bottom there, essentially no return, particularly for the short end, for those instruments that are short-term or have low interest rate sensitivity. And then as you look more recently, even just this most recent quarter, green versus blue line, you see that entire yield curve, which is still inverted, by the way, has shifted up. And exactly as Vince said, cash rates are now in short-term cash and cash equivalents are now north of 5%, and that's meaningful. It wasn't all that meaningful when inflation was 8-9%, but as inflation is coming down below the cash rate, you're actually earning a positive real yield, and that starts to become a little bit more accretive to overall portfolio growth. So we do think that all the inflows that you're having, still obviously a challenge in terms of putting that capital to work through your asset allocation, and especially in the private markets that need to be paced into. But certainly the opportunity cost for holding some of that additional cash has become less and less over time. So that's been very helpful. Just in the interest of time, I'll stop here. Happy to take any questions. Otherwise, we'll move you into the fund performance.
Okay, I'm going to take you to page 25 of the diligent book. And at the top, we're looking at asset allocation. On the left, the land grant and severance tax on the right. Just noting that you'll see, as you have been away from your target allocations, just a reminder, there was a suspension and letting money be held in cash and in core fixed income, and to a certain extent non-core fixed income during this period. As you were looking at asset allocation, also having money flows and actually having cash that is paying you a good rate. So you'll see that you're off your target allocations across the board. Now, as a reminder, allocation changes that were made will be effective next report, so effective July 1. And also when you see non-core core fixed income and non-core fixed income, those names change to public fixed income and private fixed income effective next report, effective July 1. So you'll see as right below that, against the target, you have money in cash. Again, that is you have cash flows coming in, as we've talked about, and also as Matthias was saying, cash is in such a bad place right now. Allocation on pages 26 and 27, the same stories are true here, and there will be changes to these asset allocations effective July 1. So I wasn't going to spend much time on that. Let's go to page 28 and look at performance. This report is really a check for the council to are you meeting your policy expectations. And you'll see for the land grant, the 5-year return at 7.02. The policy was at 7.03. The index was at 7.3. So you trailed your 5-year by 1 basis point. And that was the only time period, if you look down below at land grant, both gross and net against the land grant policy index, 5 years was the only period, annualized period, that we show here that you trailed, and you only trailed by 1 basis point. So let's, look at the other time periods, shorter and longer, you outperform that your policy benchmark. So that's good news. On the severance tax, it's a little bit different. You'll see for the calendar year to date and for the 1 year, those were the two periods where severance outperformed the rest of the time periods. Severance taxes underperformed its policy benchmark. So that's a bigger no than the no for land grant, which is only a 1 basis point no. Let's go to page 30 and look at attribution, where your performance, where you're getting your performance. Again, this is for the period ended, a 1 year period ended June 30th. As we all know, your return was the green line, 7.17. We all know that your return mostly comes from your strategic asset allocation, and that's the blue line at 6.58. So what else made your return better? And it says taxable asset allocation. Matthias and I talked about this before. That's really, I think, a bad naming, but you're not being tactical, really. What it's saying is, are you away from your benchmark? And you know you've been away from your benchmark. You've been getting cash in and holding that, suspending some of those targets. So you have not been at your target allocation. It's harder to get into quickly into the privates. So being away from your target allocation for the year was a slight negative for you, a 75 basis point negative for you, but you made that up. If we look at your style, like how you are positioned relative to your benchmark, that was actually a positive. That's the orange, positive 0.67. And then for the 1 year period in total, your managers added value. And most of that came from real return for that period that you can see across the board, with the exception of your non-core fixed income for that short time period and a little bit in private equity that managers added value. So that's where your 1 year return came from. You outperformed, and a negative, if you had been at your policy benchmark, had been able to beat your policy benchmark, it would have even been stronger. We have the same information on the next couple of pages for the severance. We know that severance has trailed. We also know that you have private equity that is not as diversified. It's in the state. That has been a headwind for you. So you're had outperformance, as I mentioned earlier, for the 1 year, but it wasn't as strong as it was for the land grant. The following two pages, pages 33 and 34, look at calendar year to date performance for the total fund at the top of 33, and then for each of the funds. Again, this is calendar year to date. This looked a little bit different at the beginning of the year, but with the strong equity performance, the funds that had more equity in their portfolio did better for the calendar year, and you can see that when you compare land grant to, let's say, to the early childhood. But remember, those allocations are changing going forward. Let's go to page 37. As you know, how you do to your peers is not an objective, but we show you how you've done to your peers because it is a good kind of gut check for you how you've done. This peer group, though, includes pension plans as well as sovereign wealth funds. So in looking at this chart, this is for land grant. You can see your land grant total fund return and your land grant policy index return. And then below that, the universe that you use most commonly, the greater than $1 billion, there's 92. For the quarter, there were 92 participants in that. Usually is around 80, 90 participants in that universe. And for the quarter, as expected, because you have less in equities than many of your peers, your ranks weren't as strong for the short-term period. But if you go out, and at the 1 year, you're slightly below median 2, but remember the numbers Matthias showed you, that equities public equities in general did quite well, and you're underweight that. But looking longer term against that universe, you rank for the 3-year 18th percentile, so top quartile performance, 5-year 28th percentile, and 7-year 30th percentile. So longer term, you're well above median, really close to that top quartile, top third, relative to this universe of peers. That is shown on page 19, where we show 5-year rolling peer ranks, where you place in that 5-year rolling period.
Good.
Okay. This, you can see that, it's really since 2014, the goal was to never be at the top, never be at the bottom, and you can see that 5-year rolling rank has been consistently around the median. More times, often than not, you've been above median for that 5-year rank, but you're more consistent. And that consistency is really shown on the next page, page 39, where we're looking at the Sharpe ratio, which really is a measure of return achieved per the risk taken, and you can see this is really a great rank for you. This again is looking at the 5-year rolling period, and across the board, really since 2017 and before 2016, you've ranked in the top quartile. So that's a number we think you should be very proud of. We have on the following 2 pages for severance, their peer ranks, as you would expect, they are lower than the land grant. But let's now go to asset classes quickly because we've got a lot of information, and we summarize them on page 44, but I'm going to take you to a few pages, beginning with page 46, which is looking at U.S. equity composite relative to the benchmark, the Russell 3000 that's in your policy. And if you go, and I'll just say that there have been no manager changes. Page 47 looks at the performance, and as we've talked about before, Starla and her team have made some changes to the portfolio in the near term, and that has paid off. Where the 5-year, though, you're still below your policy index. If we look at your 3-year, you've outperformed. So what was done was you have more of an index, so a lower fee approach for large cap. You have less active management, and you had a bigger small cap bias in the portfolio. That's gone, or much less now. And if you look down below and you look at the large cap composite return versus the small cap, you can really see that large cap for this entire period has outperformed small cap. Now, if you go long term, that's a different story. The small cap, a little bit more risk, a little bit more return, but certainly in this last 10 years, that on an annualized basis, that has not been the case. But the long and short, you've met, not for the 5-year, but for the shorter term with the changes, you're beating your benchmark. And done that on page 48, you see your risk return. You're in that northwest quadrant where you're above median return against your peers, and taking less risk to get there. On the non-U.S. side, let's just go straight, no manager changes there. Page 52, this, you've met your policy index, so by 52 basis points for the 5 years, and you can look on each of the time periods shown, you've had outperformance on a gross and net of fees. Interesting to look here, though, that having exposure, you have developed markets exposure and emerging markets exposure, that here, yet again, like on the U.S. markets, developed is much better than the emerging markets for the time period shown. But you've met your policy benchmark there. And in the interest of time, let's go to page 56, and this is on your fixed income. Again, just pointing out that you're, instead of being core and non-core going forward, you're going to be private and public and private, and the allocations are going to be changing. But performance-wise, going to page 57, in both cases, the core and non-core, you've met your policy expectations nicely. As 2 takeaways here, you've had, as I said, outperformance for both composites. And having exposure to the non-core portfolio has been very additive. 2, you actually have a higher allocation there, and you can see across the board it's had outperformance against the core during these time periods shown. The following pages are asset class, your alternative asset classes, and you have the managers here, so I was not going to go through those. And Matthias and I will take any questions on the June 30 report.
I have one question.
I think it's on page 30, where the performance attribution. How do you sort of disentangle the style selection relative to the manager skill? It looks like a lot of it's coming from the non-core fixed income. So I'm just kind of trying to understand what style selection really represents in this framework. You know, is it like we're more in private debt versus the index is more in bank loans, or?
There is no great index, so you have a custom index there, which includes high yield, and it's also lagged, majority of it's lagged a month. Isn't that the case? So it's not a perfect benchmark. That benchmark is going to be changing going forward. So there is not a perfect benchmark, so you're not, we tried to get you as close with that custom benchmark as we could with investable benchmarks, and there is no non-core perfect benchmark. So you have one benchmark for the portfolio that is non-investable because it's what's the second one? Is it cash plus? And so we didn't use that benchmark because you can't invest in that. So it's not.
Yeah, my question is less about the benchmark as opposed to just disentangling style selection versus manager skill.
I would say it works a lot cleaner in the public markets where, for example, you have value versus core, growth versus core, and you sort of isolate that at the style basis, and then on the manager side, then what is it actually adding over that specific style benchmark? So that's the difference. In the private side, you really don't have that differentiation, so it's probably better to look at style and manager together. Sort of collectively.
Sort of be adding those two numbers.
Exactly, because and sometimes what you'll see is, you know, the one will be positive and the other one will be sort of negative, and it's really the net of that, and it's because of the benchmark nuances. So I would encourage, and I certainly do look at for the private side, look at those two together because you're really starting to get pretty much in the weeds where there's no great delineation at that level for the private specifically. It works a lot better on the public side.
Okay, got it.
So in that case, for the land grant, you are 2 basis points ahead. So, yeah.
Okay, thank you.
Thank you for the question.
Any further questions before we move on? All right, we're going to now go to our quarterly reports, and we'll start with private equity. And if we could move the mic back. We're on agenda item 2D for those listening.
Morning, everyone. Joined by Amy Ridge and Richard Pugmire from Mercer. We're going to walk through the performance reports for the National Private Equity Program and the New Mexico program. We're pleased with the performance of the national program. It's you know, over the 3 and 5 year period, it's caught up to the indices, which is pretty amazing. When I joined 6 years ago, there was a pretty large legacy portfolio, which, as you can see, is kind of performed okay, but not great. And just to be, you know, I think it shows the work that Mercer's done for the last decade to bring that up. To see a 24.5% for the 3 year in particular. Our portfolio is a little more mature. We were pretty careful in the 2021 timeframe. We're still receiving distributions greater than contributions, which is abnormal. The industry generally is about, you know, 60 cents of distributions for every dollar of contributions, which is creating kind of a liquidity issue in the market generally. And between the growth of the permanent funds plus the fact we're not denominated out, it's giving us an opportunity to look at some really interesting opportunities on the investment side. So I'll pass them on to Amy for a little more detail.
Great. We could do page numbers.
Perfect, yes. Good morning. Good to see everyone. We're going to start on page 70. It's the slide titled Performance Overview. And so what we're looking at today is your Q1 2023 performance numbers. You did have a quarterly gain of 2.4%. This is the second gain in the national program. You had a 2.1% gain last quarter. The Q3 and Q2, they did have losses, so you see that come together in your 1 year, which is a negative 1.1%. But when we look at the longer time horizon, you know, the 3-year, as Chris has mentioned, 24.5%, and the 5-year, 16.5%. And you could see by the portfolios, those gains are really being driven by your 2011 and after portfolio. The 2009 and before, it's really, there's not much left in there, so it's not driving a lot of those values. Also, very importantly, you know, since inception, you have a 12.5% IRR, and you've generated $4 billion of gains in the portfolio. If you go to the next page, page 71, we're going to take a look at the summary of the numbers in the portfolio. So I just want to highlight a few here. Your NAV, when you look at that, you're up $51 million for the quarter. You do see that negative 1-year IRR taking effect on the net multiple net IRR year-over-year returns, which are down slightly. And then on the bottom, you see cash flows, and that's, again, what Chris was just saying. You have distributions outperforming contributions, which is a great thing to see in your portfolio. I would also just mention buyout and growth. They're really generating the returns, as you can see up here. In the venture capital, we've spent a lot of time looking at venture this year, but those are new. So a lot of the venture performance is in your legacy portfolio, and we are going to expect those to stay low for a little while longer as the funds that we've just started bringing to you all it's going to take a little while to build some value in those. If you go to the next slide, 72, we're looking at the change in net asset value over the last 2 quarters. So again, you see here, your Q1 NAV was up $51 million. So you had an $84.4 million gain, but partially offset by distributions exceeding contributions by $34 million. But it is great to see in that second quarter distributions exceeding contributions, and that's really just the strength of your portfolio and the age of your portfolio, because there's been a lot of market turmoil, and so we haven't seen that in a lot of other portfolios. And if you go to 73, we're looking at the actual quarterly portfolio highlights. So on the left-hand side, you see your cash flow activity. Very importantly, you actually had 2 distributions in the quarter that surpassed $20 million of returns to you. So I'd like to call that out. And again, you can see the difference in contributions and distributions. Also, the gains. So a lot of your gains are driven by your buyout portfolio. It's been really interesting. GPs have been reporting that portfolio companies continue to perform really well. That's been really the message that we've heard with portfolio companies continuing to increase revenue and EBITDA. And so you can see that in both the write-ups that we're seeing in the portfolio and also the distributions that we're seeing. Go to the next page, page 74. We take a look at vintage year performance. So what we do is we pool the performance of all funds within each vintage year, and then we compare it to the Burgess Private Markets benchmark. And so that really shows you the vintage year performance. Just as a reminder, our target is to get above median performance, and that's really, you know, to build a large diversified portfolio and also managing risk. So since 2011, all funds, except for 2013 and 2018, are generating above median performance. And it's also important to look at from an absolute basis. So 2011 and after, every vintage year is generating at least a 10.9% IRR. If you go to the next page, we also look at it compared to the PME. So we take the 10-year cash flows from the private equity portfolio, and then we apply the index values to it. And so you can see here, the MSCI ACWI, you are outperforming. That's really showing you different geographies. That's a benchmark that includes US, European, Asia. So since you have a global portfolio, we like to compare it there. And then you have the US-centric benchmarks, larger companies and smaller companies. But overall, you are outperforming each of your benchmarks. And the last page that I will end on is the strategy target. So just a quick check on where we are in the portfolio versus where we are targeting to be. So you see strategy and geography-wise, we are generally in line. We're slightly over venture capital, only by 1%. As you all know, we've been getting access to some great names, so that's why we've been bringing more in front of you. And Europe is just slightly above at 28%. So, generally in line. We also pay attention to concentration. So you have no managers that currently take up more than 10% exposure. And then you do have 4 fund series that in total represent more than 5%. But these are really strong performing fund series. When you look at the actual performance of these 4 fund series, it's generating between an 18% IRR and a 32% IRR. So they're good ones to be over-allocated to. And finally, we have brought a lot of managers this year, so thank you all for bearing with us and all of that. We do have 37 managers. That's slightly above the 30 core manager target, but again, we've been getting access, and so we thought worthwhile to have more managers. And then you're slightly above where we like to be in a fund count. We're at 132 today, but 48 of those are in the legacy portfolio and are really kind of in runoff mode. It takes a while to get them fully liquidated. And so you'll see here, you only have $88.9 million of remaining value in those funds. So with that, I'm happy to take questions.
Questions from council? All right, hearing none, we'll move to the New Mexico program, agenda item 2E.
The New Mexico program is a little more concentrated, as you're aware. It's also reflective, I think, of a venture capital portfolio, which is a little more volatile, generally speaking, right now, particularly out in the environment we just came out of. Venture capital is generally kind of underperforming as well. So I think the performance reflects that, but I'll let Richard talk a little more detail.
Thanks, Chris. Good morning. I'm going to cover the New Mexico program performance. I'm going to start on page 91 of the materials, where we talk about the different time frame performance. And as Chris mentioned, I think there's 2 things to remember about the New Mexico program, especially as we've just heard the national program performance report. I mean, it is more concentrated than the national program. We've been working to diversify that more, but with private markets, it does take some time to diversify it. And in this market, fund managers are deploying capital slower than what we saw in recent years, and so that's going to take more time to diversify. And then also it's more venture capital centric because we have the economic development focus. We're more venture capital centric because we want fund managers that are going to be looking at early stage New Mexico companies. And so we are more venture capital centric, and that sub-strategy within private equity has been hit harder than the overall national program performance. But that being said, though, there was a quarterly gain of 0.7%, which was driven by a write-up in the co-investment fund in the first quarter. You can see here on the 1-year return, it is a negative 9%, driven by both the fund investments and the co-investments, which are the largest exposures in the New Mexico program. Performance is really negative across all time horizons except the 10-year and the since inception. And going line by line to talk about each one, the Catalyst Fund, which is the fund of funds that's focused on New Mexico-based managers, that's a positive 2% since inception, but it's not a large commitment in the program, so it doesn't make that much difference to the overall performance. You have the co-investment funds, which have a negative since inception performance of 0.1%, and these are a large portion of the current net asset value in the program, about 57% as of the March 31st report. And that does have a negative impact on the overall return. You can see a loss there of $3.9 million since inception. The Recovery Fund, which was the fund that basically helps New Mexico businesses post-COVID try to have enough capital, more debt-oriented fund. That's had positive performance since inception and has contributed to the overall performance with a $3.7 million net gain. And then you have the fund investments. And we split the fund investments from 2008 and before and 2016 and after. There was no fund investments in between those years. And that really reflects a change in the legislation where there was a requirement to open an office in New Mexico and staff it with a senior person, which narrowed the funnel of funds to choose from. And the 2008 and before, which is more of the legacy portfolio now, that has been struggling. You can see it has a loss of $5.7 million, a since inception IRR of negative 0.3%, whereas the newer fund investments have been performing well, although on a one-year basis, they got hit with what we've seen in the overall market with venture capital getting hit. But a lot of the value in the newer fund investments is still unrealized, so it can be volatile as well, depending on what happens with both the companies and market conditions. From a commitment activity perspective, we've done $97.5 million of commitments this year to 2 managers, and we have 3 being presented today for you. Next page on 92, just real quick, this is the net asset value change. The net asset value overall decreased by about $8 million. The one thing I'll point out on this slide is you can see the impact of that negative one-year return on the overall since inception returns, where the since inception IRR went from a 1.6% to a 0.7%, and the net multiple went from a 1.12 to a 1.06. To get into more details on the net asset value change on page 93, you see a similar graph that we have with the national program that shows what really drove that decline in net asset value. And we've also been receiving distributions in the New Mexico program. A lot of those distributions have been driven by the recovery fund. As loans have gotten repaid, that cash has been returned to the SIC, and so we've been receiving a number of distributions there. And you can see that number, $12.8 million in the first quarter. One thing about the contributions, though, is we did see more contributions happen post March 31st, as some of our newer commitments that we made started drawing capital. In particular, the Frontier Fund, which you approved in November, they drew capital to establish Roadrunner Studios, which is the New Mexico-based venture studio in Albuquerque, and that's now been established and is actively seeking new technology to build companies around. They have a couple that they're working on right now. And so the impact is that we actually have a net contribution of $25.6 million through mid-August. So we do have more contributions and distributions in the New Mexico program through mid-August, even though the first part of the year started strong for distributions. And the next page, 94, you can see that in the first quarter, the New Mexico Recovery Fund was really the driver of those distributions. The vast majority came from that. And you can see where the write-ups came from, which was the co-investment funds, really just driven by 2 companies that were written up. The next page shows the economic activity. Page 95 is where I'm at. Not many changes quarter over quarter. As of March 31st, we have 117 New Mexico-based companies, with one new company added to that total over the last 12 months. At the SIC level, $384.8 million has been invested in the New Mexico-based companies. And then from the funds themselves, so including other investors' capital in these funds, $518.4 million has been invested in New Mexico-based companies, with $12 million being invested over the last year. So that's not just the one company, that's also follow-on investments into New Mexico-based companies. And then the next page, page 96, has the job information, and really not much change quarter over quarter in this number either. You can see total jobs reported at all companies is 4,611. There's been job growth since inception, and that's really the since inception of the investment in the company is 2026. Not since the inception of the company, but since inception of the investment. And then the annualized New Mexico payroll is reported at $219.5 million, and expenditures in New Mexico was at $237 million. We have some other slides that go into more of the portfolio composition of the New Mexico program, but I'll stop there and happy to answer any questions.
Questions from Tom? We'll move on to real estate and real return, and I believe all these folks are online. Mr. Sable?
Good morning, Madam Chair. I'll lead off with some preliminary comments on the performance of the real estate portfolio before handing off to Seth. The content for this portion of the presentation begins on page 113 in the board book. Broadly speaking, public REITs were flat as measured by several public indices over the course of the quarter, and they've been generally trending flat to slightly down since then. The portfolio was down for the quarter and 1 year periods, but performance was positive across all longer measured periods in the report. More importantly, across all of the measured periods, even the more recent ones, the portfolio has been outperforming its benchmark. The key trend that we're seeing across the portfolio is that steady income from properties has been insufficient to offset marks related to valuations on the underlying assets. The net of those two has been negative total returns over that trailing 1 quarter and 1 year time period. Broadly speaking, as a reminder, core real estate valuation is an appraisal-driven process, and that is inherently slow to adjust to market changes. There's been a pretty big disruption in the market attributable to the rise in interest rates, and that is causing signs of stress and difficulties for property owners to finance and refinance properties. Price discovery only occurs in this space with the actual execution of transactions, and transaction volumes have been relatively slow. So all this boils down to a process that will take some time for the interest rate regime to be baked into the underlying valuations of the properties in the real estate portfolios more broadly. So until that activity picks up, we're expecting more of the same. So modest returns, probably slightly negative for as much as a 1 year time frame from where we are. With that, I'll hand off to Seth.
Thanks, Keith, and good morning, everyone. So the Townsend team here, along with Keith being remote this month, give you a little preview of next month's agenda. We'll be there front and center on a number of different fronts. So I look forward to seeing you then. I'll begin with some comments on real estate. Malcolm, Blake, and I are going to tag team the real estate performance report, and then Rob will speak to the real assets. At year end, for both performance reports, we included fund summaries for every investment. That was what we presented back in June. So without those, this quarter, our portion of the book is a bit shorter, but it starts. I'm going to start on page 116. As Keith mentioned, 1Q23, which is our performance as of date in this report, was another quarter of real estate valuations adjusting downward. This is the third consecutive quarter, so that did result in a negative 1 year return, so negative return on an absolute basis. However, again, just reiterating Keith's comments, our portfolio, the SIC's portfolio, was less negative than the market, therefore outperforming on a relative basis over all time periods, and that's again shown on page 116. This outperformance varies from about 60 basis points over the current quarter to 340 basis points outperformance over the 3 year period, and then in different periods, different outperformance. I will mention we include in this chart the entire portfolio as the first bar, the legacy portfolio, which does still exist, but it only represents just 1% of the NAV today. A lot of that has been sold down and liquidated, and we should have another one of those sort of liquidations in process or completed in the near term. Like the comments I've made historically, what's driven our outperformance relative to the index or to the universe is our sector weightings, our property weightings, and a lot of what you've heard from the team historically regarding the structure study and sort of the overall plan for the portfolio. So we are underweight the property types that were hurt in these markets the most, and we are overweight the good property types. Specifically industrial, we have a high allocation to industrial, about 39%, as well as non-traditional real estate, which is about 12% of our portfolio. Non-traditional is outside of the 4 major food groups. When you think about the 4 food groups of real estate, it's apartment, office, industrial, and retail. And then this other category is growing in interest, and we've made some commitments specifically to the sector. Bain was one last in June, and we have a couple on the agenda going forward. And this exposure is primarily in medical office buildings, non-apartment residential, self-storage, senior housing, student housing, et cetera. So those have performed, outperformed in the market. And then our underweight to the underperforming sectors are office and retail. Office is obviously a continued concern within the real estate sector, given since the COVID environment and really even before then. And then retail has actually performed pretty well where we have exposure today. It's grocery anchored, it's experiential retail that has really come back and also just performed well throughout the different cycles. Maybe with that, I'll hand it over to Malcolm to talk a little bit about some of the other pages here in the report.
Great, thank you, Seth. I'll start off just as a reminder, the New Mexico State Investment Council has a $3.8 billion real estate program that has a 12% allocation and is currently 9.7% exposure based off of March market values. Seth alluded to this earlier. Because of this, we'll be back later on in this year to help aim to increase and hit that target. This exposure is 70 bips less than what year-end 2022 was, primarily driven by your planned growth, but also impacted by negative returns. This year calls for $1 billion in commitments to be made. $650 million of that has been approved year to date, but we'll be back later on this year to follow on the themes that have been mentioned previously. Moving to page 117, Keith and Seth already touched on in performance, but one other additional item I'd like to hit on is income. Both portfolios, the legacy starting in 2005 and the 2011 inception, have had consistent and steady returns despite ongoing market value corrections. This offers good downside protection, but the portfolio has also witnessed good appreciation during those periods as well. Moving to page 120, this covers significant events in the portfolio. We'll start this by discussing Jamestown. This is a platform that's challenged due to its office and retail exposure, most of which are in gateway markets. These allocations and exposures are challenging to the overall firm. However, Simon Property Group, one of the largest retail REITs in the market, recently acquired a 50% stake of Jamestown. This will add stability and knowledge to the platform. The other events listed on this page are for Airmont, Angela Gordon, and Invesco. Angela Gordon is the one of the three that we are watching the closest. Angela Gordon recently has an acquisition, was acquired by TPG, and this will take time to play out fully. The other two, Airmont and Invesco, are more routine leadership changes, so we are less concerned with those. Moving to slide 121, this covers a PME, a public market equivalent. This is comparing performance of the real estate program portfolio against a public market hypothetical portfolio or investments. What you're seeing here is a healthy illiquidity premium that you're benefiting from for being invested in private markets, which is nearly 1,000 bips for the 2011 inception portfolio, excuse me. Moving to page 122, these are two of the largest positions in that real estate portfolio, making up 31% of it. Both of these, Line Industrial Trust, LIT, and PRISA, are large positions here. LIT is a pure play industrial and outperformed the benchmark over the quarter and 1 year periods by 220 bips and 1,500 bips respectively. Looking forward for June numbers, it beat the benchmark again by 180 bips this time. Going to PRISA, this is a diversified fund which outperformed the benchmark over the quarter and 1 year periods by 156 bips and 150 bips respectively. And again, looking forward, it continued to beat the benchmark by 90 basis points. The final page I'll touch on is page 128. Seth addressed the property type overweights, so I'll look past that. And now moving to geography, the portfolio is 88% invested in the US. And the one item I'd like to highlight here is the underweight to the Pacific region. There have been a number of challenges or a number of markets in this region that have faced challenges recently, such as San Francisco and Los Angeles, and it's been beneficial to underweight this in near term. And with that, I'll open up to questions.
Hearing none, we'll move to real return, agenda item 2D.
Great. Thank you, Madam Chair. I'll again lead off with a couple of comments before handing over to Rob. The real return portion of the presentation begins on page 147 of the board books. In terms of performance, the portfolio has lagged over the 1Q period while outperforming over the 1 and 3 year time frame. Quick reminder on the structure of the real return portfolio. That's comprised of 80% real assets and a 20% real return bucket that's further divided into MLPs, which comprise about 10% of the portfolio, and then another financial assets sleeve, which comprises about 10%. Real assets generated positive returns over the past year and were a beneficial diversifier for the overall SIC portfolios. By way of reminders, traditional infrastructure investments are characterized by inflation-linked revenue streams and volumes that are less sensitive to GDP variability, and they also have typically long-term financing arrangements. The mark-to-market of the liability side of real asset balance sheets was particularly helpful in this rising rate environment, as it helped to buoy net valuations overall. Portfolio continues to have sensitivity to energy prices, and that's driving both returns and volatility over the longer term. You'll note that 39% of the real asset portfolio sits in energy-related exposures, and approximately half the infrastructure bucket is energy-related as well. And there's another 10 points worth of exposure that's derived from the MLPs that are in the smaller bucket in the real assets portfolio, or real return portfolio rather. Financial assets bucket has continued to generate steady income stream over time, but has lagged the CPI plus 300 benchmark. That's largely a function of debt instruments not really being designed to be inflation hedges. With that, I will hand off to Rob.
Apologize, I almost forgot to unmute. Good morning, everybody. Thanks for having us today. Happy to talk about real return. You know, as Keith said, this portfolio is comprised of a variety of asset classes that, generally speaking, there's a hard asset component. There is contractual income, and these asset classes are collectively designed to provide some inflation hedging for your program. And as you'll see in a minute, the performance is providing that inflation hedging as we have a CPI-based benchmark. And you're exceeding that benchmark over time. You've got $3.1 billion invested in real return assets, and that makes up 8.2% of your total investment program. The target is now 12%, which is about 4.6 or 4.7 billion. So we've got to grow this program by about $1.5 billion to get to your target allocation, your new target allocation. And as continuing the theme from real estate, you'll see us more later on this year as we bring forth a number of new investments for these portfolios. I'm going to start on page 151 in your book, and just Keith summarized the performance already, but a couple of comments. We just want to highlight again the diversification benefit of this program. You know, real estate is correcting across the nation. It's, you know, just kind of a macro correction in real estate, but this portfolio is actually holding up quite well and still generating positive returns, despite having a lot of characteristics that are similar to real estate. And as you can see on page 151, over the long term, the program's got a healthy premium versus its benchmark, which consists of CPI or inflation plus 300 basis points. So over the long run, the program is doing its job in providing that above inflation performance. There is a dip in performance in the 5 and 10 year numbers related to an energy correction that occurred in the middle of the last decade. And you're going to see that, you're going to see that in your numbers for a while now. But over the long run and in recent time periods, the portfolio has performed very well relative to your benchmark. If you go to page 153 in your program, to highlight some of the components of the real assets piece, as Keith said, you know, energy and infrastructure are the two largest components. of your real assets portfolio, but you also have exposure to agriculture investments, timberlands, and then there's a collection of kind of other category that includes some what we like to call movable infrastructure or assets. It's an asset-based investment strategy that is not a fixed property, but it's a movable property, and then some private equity oriented investments in that program. We don't have any commodity exposure right now, and there isn't any intention to add that in the near term. We'll be focusing primarily on infrastructure and maybe some midstream energy. You'll hear in your at future meetings additional commitments in those two sectors. If you move to page 154 in your book, just to talk a little bit about the growth of the program, incepted in 2011. And pretty consistent growth over time. We like to highlight the fact that you've got relatively good vintage year exposure, meaning you've got good diversity by vintage year here. The program has typically made 3 to 5 commitments per year at collectively investing $300 to $500 million per year. And you can see in 2022 and then again in 2023 projected that we expect to increase both the level of commitments as well as the dollars invested in 2022 as well as in 2023. So more to come on that in future meetings. And if you flip to the next page, this is just the performance on the real assets portion. These are more the hard asset investments. This is the agriculture, energy, timber, infrastructure in your portfolio. And it's a similar story to the overall real return portfolio. Good numbers over the long run. You can still see a little correction in your portfolio related to energy and the 5-year return. But the real assets pieces of this portfolio are also holding up well in the near term when a lot of leveraged asset classes like real estate are correcting. I might just comment, in the quarter, the program generated about $57 million worth of distributions. So this portfolio is also distributing quite a bit of cash back to you, and you'll see that as a continuous distributions of cash out of this program going forward, and that's going to impact the amount of investment you need to make to recycle that capital and continue to build asset value. Moving to page 156. Not going to cover a lot of detail, but just note that the real return program consists of 63 investment accounts invested by 27 managers. Your investment office and Townsend, we're constantly monitoring these platforms for a variety of issues that pop up. Right now, we're not really concerned about anything here. One thing to note is one of your funds, the JP Morgan Infrastructure Fund, we expect a meaningful fee reduction when that fund hits a certain threshold of asset value, a 55% reduction in the management fee. So that's a positive. The other items here are mostly minor amendments to partnership agreements and some succession of leadership, a lot of times related to just retirement of people that have been in the industry for a while. And finally, if you go to page 160 in your book, just a word about the geographic exposure of this program. The real return program is a little bit more global in nature. You've got about 30% of the program invested outside of the U.S., but 71% is invested in North America, mostly the U.S., and 83% of the program is in developed markets. That's centered in Asia and Europe. And you have about 17% exposure to Latin American markets. So that's your emerging markets exposure in this portfolio. But generally speaking, this is consistent with what we observe, especially in the infrastructure sector where managers are invested heavily globally outside the US. And with that, I'll stop and ask if there are any questions on the real return portfolio.
Thank you to Townsend and Mr. Stable for those reports.
Thank
We'll move on
you.
now to agenda item 3, our investment recommendations, and we'll hear from our investment committee chair, Member Lester.
Thank you, Madam Chair. We had as always, we got to have an economics and finance graduate level course at the finance committee, at the investment committee meeting. Vince teaches that once a month with us, and we get to learn a lot of really good things. I think that I want to make it clear that the recommendations coming to the council for this meeting, we didn't have a quorum. We were limited. Mary Roman and I, our advisor Mary Roman and I were there, and fortunately, Madam Treasurer, the treasurer joined us. So there were 3 of us who were able to listen, but these are coming simply with the responsibility will fall on the council to make these decisions, as we always do. But Mary and I did recommend each of these for approval. So had there been a quorum, that would have been what we would have communicated to you and the council. We also, the committee is going to discuss in the future the possibility of, we want to have a discussion with the governance committee to talk about the possibility of changing our process a little bit, and that is having to do with re-ups. When we have the same company and the same strategy, the same firm and the same strategy, the CIO has indicated that it would be really helpful if they were able to move forward with that under that set of circumstances and bring it to us after they've made the investment. And we're going to talk to the governance committee about that, and we'll bring a recommendation to the council at the next meeting. Other than that, the report starts on page 184, 183, 184, but in the book. But at this point, Vince has an item he wants to cover about strategy, and I'll turn it back to you, Madam Chair.
Great.
Okay. Well, Madam Chair, there's just a few slides in here, and we'll zip through them. But this is the first of 4 presentations we intend to make for the rest of the calendar year at your meetings. We went through the annual investment plan with you in June, as we always try to do. It was August the year before, but we just had the bad luck that we had 9 investment decisions in the same meeting, so we had to rush through it, and we just didn't get to hit some of the things that I really thought was important. So this month we're going to talk just briefly about demographics and some of the changes that are happening that are being driven by that. Next month, Nino's going to pull Nino Carpenito on the strategy group is going to pull the curtain back a little bit on the pacing model that we use. Really important. Half our portfolio is allocated to the private markets, and what investment sizes and how many investments and the total commitments that we make each year are really important to getting to our targets and maintaining that. And there's a ton of work and just real complicated stuff, but he's got a good and short presentation on that to kind of pull the curtain back a little bit. That'll be in September. Then Don's coming in October with an update to our inflows modeling. I think you'll find that interesting. And then in November we'll bring the investment policy with a couple of small changes. So we'll try to do these. We'll try to keep them short. That'll wrap up what was in the annual investment plan. I'll feel a whole lot better if you all get to hear those things. So there's just a couple slides in here, nothing really fancy report-wise or anything. One of the longest-running themes we've had in our annual investment plan is the theme of low rates of economic growth globally, inclusive of here in the United States. That's really important to setting our strategies and our asset allocations is recognizing that real GDP growth in the world is falling. In fact, the World Bank, which tracks us as closely as anybody else, maybe other than the IMF, has come out with a report just a few months ago that said global the potential economic growth rate in the world is going to fall to its lowest level in 30 years and stay that way for 10 years. And that potential economic growth rate is just simply the rate of growth over the medium term that does not, it's as high as it can get without igniting inflation. It's fairly accurate. They can forecast those things fairly accurately. So we're definitely in that low growth environment. We've been right in our annual investment plan, and we're expecting that to continue. One of the things that's driving it, one of the big factors is the demographics in the world are are really starting to deteriorate. And we're going to go through a couple charts here to show that to you. But there's three things that are happening. First, global population in the most economically impactful economies is peaking and shrinking. So global growth of population is still increasing, but the big increases are in countries and places that don't have a lot of impact economically. So the big economies, China, U.S., several economies in Europe, we're all, except for the U.S., we're all shrinking. We're getting close to doing so. The second thing that's happening is global populations are also aging at the same time. So we all get older, but as a population, we're getting older. We're not making enough young people and kids to replace ourselves, and therefore the entire population is getting a little bit older. And that's got some impact we'll talk about. And then last, productivity growth is low and has been stagnant, and it's a little hard. You can pick out a few things, some of the frontier technologies, the AI and stuff that perhaps will bring more productivity into the economy, global economy. You can see some of those things, but the path forward to better productivity growth just is not very clear at all, and that's important too. So if you take the size of the labor force, which is related to population size, strongly related to population size, and add in productivity, that is GDP. So we've got shrinking populations combined with low and stagnant productivity, and that's why growth rates are low. So if you change to page 187, we plotted out here for you the projections for populations in a number of the big economies. Sorry, that chart's a little fuzzy, but so it goes out to 2050. You kind of need to look out, 20, 30 years to really get a handle on what's happening with demographics, because it all moves slow. It's just all a big math model. But you can see Japan, we've known that story for a long time, really starting to shrink. They're starting to help themselves. They've got some family support type programs going on in Japan that seem to be having some effect on their fertility rate. But still, they're at the bottom of the stack. Russia and China are two of the worst demographics in the world. We'll look at their demographics chart here in a minute. Italy's right there with them. You'll be shocked when you see that chart. And then you can see from the United Kingdom down to Germany, inclusive of the entire Eurozone, those populations have peaked or will peak soon, and will be sliding. That's one of the problems that's happening in Germany right now. They've just aged out. They're not short on children; they're short on young adults now. That's tough. It's a tough place to be. We'll look at their chart a little bit. The United States still on a growth path. We've got a decent fertility rate here, and that's just the number of children per woman over her lifetime. You need 2.1 to replace your population. We're about 1.8, maybe 1.7 here in the United States, so not too bad. And so the difference is we're a place that's attractive, and we get a lot of immigration. So that helps make up for our low or for our below 2.1 fertility rate. Norway, Sweden, Switzerland, those are all immigration stories there, as is Canada and Australia. And then India has got a really good population chart. We'll take a look at that here in just a second. So page 188, this is the standard way that demographers look at a country's population or region or whatever you happen to be looking at. And the way you read this chart, this one's kind of fancy. As much as we use these things, I got to figure out what some software these guys are using. So how you read this chart is the horizontal bars are broken up into 5-year age groups. So if you start at the bottom of the chart, there's 2 horizontal bars, one left, one right. That's children in the United States that are 0 to 4 years old. Next set of bars up, 5 to 9, 10 to 14, 15 to 19, so forth. So young people at the bottom and old people at the top. On the left-hand side of this chart are women and girls, and the right-hand side are men and boys. And then they've got the generations on the sides here, which I kind of like.
What are the stars?
That's the U.S. flag.
Significant to it?
Just identifies the U.S. chart. He did, the same guy got this the other charts in here are by the same guy. He puts their flags on it too. Yeah. Okay, so these charts come in sort of three different shapes. One is like a pyramid shape where there's lots of kids at the bottom and fewer adults as you go up. After you hit about 65 in these charts, the mortality tables really start crushing things down. The next shape is more rectangular. That's a little bit what the U.S. chart looks like, until you get up to that 65 or so age group when mortality tables start kicking in, where you've got kind of equal, distribution of population. The U.S. has a few fewer kids in Zoomer generation. You can see the boomers. That's the stars in the blue. That generation is getting old enough that the mortality table is catching up to it. Then you can see the millennials there, the peak bar there in 95, and above that for millennials. Very big group. So boomers were about 75 million here in the U.S. at their peak. The millennials are about 72 million. Xers are about 55 million. Zoomers probably even smaller than that. The next generation down is not on this chart yet. Demographers aren't agreeing on a name yet. They will. I've got a flag plant in the ground for homelanders. That's one of the names that's being used. That's the millennials kids. Millennials are a big generation, so we would expect the homelanders to be a little bit larger generation. So that's how you read these charts. Here's what the world looks like. It's not very pretty. Start with China. China's population is shrinking fast, and it's going to continue to shrink fast with very long projections for that population out to the year 2100, out to the end of the decade or end of the century. There are going to be half as many Chinese as there are today in 2021. This chart's actually a little bit worse than it looks. China's been out over the last year or so saying that, we kind of overcounted our people a little bit, like by 100 million. China never tells bad news on itself, so 100 million is probably a little bit low. They were more effective with the one-child policy that started in 1980 and ended in 2016. They were a little more effective with that than they actually thought. So from 40-year-olds down in that Chinese chart, you can whack off about a quarter of each side. You can see a very small base for them. Just think about China, 40 years from now. So all the people that are there 40 years old down to zero, will be 40 to 80, 40 years from now. The mortality tables will be taken out the top portion, and China's population will really be falling at that point. It's not like it's going to be good for them, for 40 years, and all of a sudden it hits. It's going to be happening over the next 40 years. So that population is really shrinking. It's got big implications for their ability to continue, economically as they have been. Same thing happened in Japan. We saw that chart. They're really starting to sink. There's very few children at the bottom. A big bulge there around those born around 1975, and then start shrinking from there. Germany's in that same boat, right next to it, top right chart. Like I say, they haven't just run out of children; they run out of young adults. That's a problem. So they're old, and their workforce is in that age group where they're very skilled. They're earning their highest incomes of their lifetimes, but they're about ready to age out into retirement with no real young people coming to replace them. Better charts are on the bottom. We like the bottom here. India's got just a great chart. You can see how they're very well supported, as they move forward. Oh, I'm sorry, I did stick Italy on the bottom. That's another ugly chart. And in France is actually a pretty decent chart. Looks a lot like the U.S., but just don't have the millennial generation that we do. Their boomers just didn't produce that for them. But pretty decent chart for France. Okay, so let's back up to page, that first page. Yeah, so that's the viewpoint of bullet point number one. Bullet point number two, though, adds another dynamic, and here's what we were commenting on, particularly for Germany. There's three critical times in people's economic lives. One comes when you're 25 to 35 years old. And this is for large groups, right? Any individual could be different, but Ages 25 to 35, that's the high spending years. So not a lot of income there. People aren't making a lot of their income relative to what they'll make over their lifetime. But they're levering the heck out of it. So they're borrowing a mortgage, buying a house, borrowing a car loan, buying a car, hitting their consumer credit and their credit cards for stuff to go in their home. That's all very powerful economic activity to do those things. So that's the age group that are spending. That's the age group that's the basis for the consumption-related economic environment that we have. The next time in people's lives is when they get 45 to 55. That's their high income years. But they're not spending money like they did when they were 25. They've already got their house. They might replace their car. They're probably wearing better clothes and eating better food and going on better vacations, but they're not spending money like they did when they're 25 to 35 years old. What they are doing is saving. And these are the capital providers in the economy. So they're paying down their house, they're making deposits to their IRA and their 401k, and they're making investments in the stock market. These are the capital providers in the type of economy setup that we have now. And then last is 65 plus people retire. I think the statistic is on average incomes go to about 60% of what they were pre-retirement. So you're spending a whole lot less in retirement, and of course that group doesn't contribute as much. They're just not working full-time in an economic sense. So what's happening, and we saw this on those other charts, and particularly in Germany, we're starting to run out of that high spending years group. That group's shrinking. That's weighing on the economy. So first, populations are starting to shrink all total, and the people that spend the most money or spend the most money in an economically powerful way, those people are starting to shrink too, and that's really hitting on growth here. The last point then, productivity. We talked about that a little bit. Just not a really clear path as to what productivity could look like in terms of picking up speed and so forth. There's one more chart in there that kind of goes over just how all those things, the productivity and human capital and so forth, have been shrinking since the 1980s. But the main point here, and there's not a slide on it, but the main point here is this is what's contributing to lower growth here in the U.S. It's also contributing to a change in our economic system. So you saw us in the annual investment plan talk about a new investment environment. That's being in part driven by a change in our economic system. So one that's been based on consumption with lots of 25 to 35-year-olds, the baby boomers, coming into that in the 1980s and moving through it, and then the millennials coming through now. That's starting to change. We're starting to have deglobalization, where free trade and globalization of labor, globalization of commodities, massive increases in trade, all that stuff's starting to reverse on us now as these populations age. So we think it spells trouble for a few countries. China's one of them. Not only they have lousy demographics that we just looked at, but deglobalization is really going to hit their economy. They've just really bought into the globalization since 1980 and really structured their economy around it. Now that's starting to go the other way.
And what's their immigration level?
It's actually slightly negative. So on net in China, for every 4,000 people they have, one moves away every year. So it's really small, but it's slightly negative on net. So long-term demographics problems, medium-term deglobalization problems. We just talked at the top of the meeting about, right now they're in a cyclical downswing, and a pretty nasty one. Kind of all the crosshairs on China. But same thing for several other countries, Germany, a lot of Europe, with lesser so in France. But a lot of those countries are facing the same kind of problems. Here in the U.S., we just look not so bad. Our demographics problems aren't as bad. Our largest trading partner now is Mexico. China fell to third place. Mexico's one, Canada's number two. So all of that's in our same continent. And the Mexican demographic, I didn't put it in, I should have, is just fantastic. It looks like India, it's just not as big. and their population is a lot younger, and it just fits hand in glove with the U.S. Demographic. So we're a little bit older, focus on a little bit of higher order manufacturing and services and stuff like that. Mexico's a little bit younger. They focus on a little bit lower value chain, production and services and things. The two just fit together great, and that's our largest trading partner. So we're relatively better off in these big trends that are happening in the world, and you saw in the annual investment plan that we're starting to focus our investments here in the U.S. just a little bit more than we have in the past, try to avoid some of those problems that we think are coming over that next 7 to 10 years. Also here in the United States, the millennials are moving into that high capital or high earnings years and providing capital. That's got it probably 7 to 10 years, right around our normal time frame, still to happen. When it does, we should see cheaper capital, lower interest rates, maybe a little higher multiples on the stock market. So out 7 to 10 years when that big generation, the millennials, move into that high earnings years, we could see a little bump to the economy. At the same time, the Homelander generation will be getting ready to come into the workforce, and they should be a decent sized generation just because the parents are a big generation. That's probably more on the order of 15 years or so before that happens. But in a longer term view for the United States, we're in a lot better shape than a lot of other places. So while we're not just completely focused on the U.S., still, half of our our publicly traded equity portfolio is diversified overseas. We've got some diversification overseas in the private portfolio, but for the most part, we're focused here. We think we're sort of at least the cleanest shirt in the dirty laundry, so to speak. And a lot of these longer-term trends are supporting that. So that's the presentation, Madam Chair. We got a whole thing on China, as I mentioned before. If you want to hear more about China, we can queue that up, between meetings or something. That's what happened. Answer any questions that you have.
We got a book, Mrs. Mighty and the Jamal.
This is what the investment committee has to tolerate every month.
Any questions on that presentation?
I have one question. Just on page 190, what are these different categories that make up the productivity? Just wasn't familiar with some of these acronyms. Or...
It's. I didn't put the source doc. This is World Bank, and they've capital deepening really is just the distribution of capital around the world. It's becoming more concentrated. Just in the very us and China, where capital is being concentrated. Obviously, human capital is just the change in demographics. You can see that kind of shrinking. And then the productivity is the actual productivity, and you can see how it's been falling. It's was over 2%. We're down under 1%. It's on the right-hand scale. The productivity.
And this is global or U.S.?
Global. Yeah, this chart came out of about a 400-page report, but I didn't read every page, but from the World Bank.
And that lowest productivity in 3 decades?
Lowest growth in 3 decades to last 4 decades. I think what they're seeing is the same thing we were just talking about. At some point the Homelanders come in, at least here in the United States, and things start to stabilize a little bit, and so they're seeing maybe better growth out past this next 10 years.
So, Madam Chair, I have a question.
Member Tiff?
Yes, real quick. I know it's been probably a whole day talking about this, but just want to first start by saying, wow, Vince, this is incredible. I mean, this is a masterpiece in our efforts to start, thinking about planning, and it's pretty impressive. But I did want to ask, so what is your sense with U.S. companies in China, and with all these kind of negative attributes? What do you think U.S. companies and others are going to do with so many negative sort of things that are at play here? And I'm glad that you're able to look at this, because I came across a similar report about 15 years ago, and it was talking about how, the demographics in China and Russia were going to really prevent them from, in many ways, becoming world powers. And so what do you think the U.S. companies are going to do with all of this, these things coming down the pipe?
Specific to your China question, if you use an iPhone and you want to upgrade it, you should probably do that. Apple, right now, because Apple has most of its manufacturing done in China, and things are just really rough in China right now. The demographics ultimately will catch up to it, but they're in a big cyclical downswing, and globalization's turning in their face. So yeah, I mean, that's a little bit of a joke, but yeah, we just really don't see China cannot continue to be the manufacturing power it has been. Not only just from a demographics perspective and the deglobalization, but their labor unit costs are now almost triple Mexico's. They've priced themselves out of a lot of markets. So we hardly have any investments in China. A little bit in public equity, and I think we've got one Asia Alts called Asia Alts private fund that may have some Chinese assets, but we basically have nothing there. With the exception of exposure through companies like Apple that have big manufacturing facilities there. COVID really helped us out a lot from that perspective, in that everybody shortened up their supply chains. Everybody has been trying to friendshore or reshore as much as they can. That's part of what's hurting China now in the cyclical sense. And then, did you have a question beyond that, Nick?
No, I'll just leave it at that. But yeah, excellent report, and just really interesting, because I hadn't heard much about it. Come across any of this kind of more recent information on demographic shifts in the world, and it seems to be that China's been pretty consistent over the last 15, 20 years. Thank you.
So hearing none, we will move to our very first investment recommendation into Antler US Fund 2.
Madam Chair, you'll see that the vote at 3F is going to codify what we're going to do. It's going to, the three investments we've recommended are going to fit within that. So that's listed to be approved on the afterwards, but it's these, I think what the great explanation is, I think these three, and Chris and his team will be able to kind of show us exactly how this particular new process is going to work. So that's why the order, I believe, is the way that it is.
I'm struggling to find the material, so I'll just let
page 191. Okay. So we're bringing this exciting month for the New Mexico program. We're recommending 3 investments this month. One, what we call a fund commitment under the policy, and 2 that are called emerging manager commitments under the policy. The first is a fund commitment, and fund commitments we can be up to 20% of a fund. Antler Global, you probably are not familiar with it. It's a global startup accelerator, and we're excited about this one. It's in many ways complementary, but different than what we recommended with Frontier Fund and Roadrunner Studio. Roadrunner is a venture studio, and what we mean by that is they create startups from scratch based on a licensed technology or some type of perceived market opportunity. And in the case of New Mexico, obviously with all of our intellectual property in the labs, the idea is they can take some of that research and commercialize it within the studio and see if they can create companies. That's different from what the folks at Antler do, which is they work with founders that want to create companies that apply to their program, and Antler, upon accepting them, works with them to try to, slowly build a company. And Antler's probably the earliest platform in this regard. They like to say they're pre-team. They're starting at the idea phase. And I think as we, slowly execute our strategy for this program, the idea is we want to see more companies created, more entrepreneurial activity. And our view is in order to do so, we need to start at the earliest stage, which in this case, in one case was the venture studio being created now called Roadrunner. And in this case, it's a startup accelerators working with founders that frankly at the beginning only have an idea, and they help them try to incorporate the company and come up with, see if the idea works and build from there. I'm going to pass them on to Amy for a little more detail on Antler and the fund.
So Antler US Fund 2, this would be, Antler's a new relationship for the New Mexico program. We have known them at Mercer for quite some time. They were founded in 2017. And as we mentioned, they're very, very early stage venture investing in technology startups. And we really like their strategy, that sourcing mechanism. You're not only getting in at very attractive valuations, but they bring more than just capital to what they are doing. And we think that that's very important, especially for New Mexico and creating this ecosystem. We really like the size and caliber of their team. They actually have over 300 people today globally. And so as companies grow, there are different ways that you can, leverage all those resources and best practices to help these companies continue to grow. We also, they have had one fund they're currently investing from. It's a 2020 vintage year, so still pretty early in the investment life cycle, but it has shown us that they have an ability to execute their strategy. They've made over 100 investments. There's been a low loss ratio. There's already some early promises within the portfolio. So that's given us some comfort that they're able to execute what they are promising. We also are excited for what they're going to bring to New Mexico. They're going to hire somebody to actually be here in New Mexico, sourcing on the ground and really helping to foster relationships, and their dedication to including New Mexico as part of their broader U.S. focus for this fund. So we are recommending up to a $40 million investment into Antler US Fund 2, and I'll turn it over to the Antler team. We have Todd Rupert. He's actually on the board of Antler. And we have Ryan Somerville and Tyler Norwood. They help lead the U.S. Fund series. So I'll turn it over to you all.
Thank you, Madam Chairwoman. Thank you very much for having us here, council members. It's a pleasure to be here. Good morning to everyone. I'm here as a board member, and maybe just give you some background on me as to why I'm on the board. I spent a 27-year career at the global asset management firm T. Rowe Price. And I had a number of senior executive roles there, including starting their global business from scratch. I retired from T. Rowe Price to invest in startup companies and be an advisor to those startup companies. And I also joined a firm called Greenspring Associates, the venture capital firm. The founder of Greenspring actually worked with me at T. Rowe Price. And Greenspring, part of their business was a fund of funds, so we had the ability to evaluate numerous funds in the marketplace. So I got to be able to compare and contrast funds in the marketplace. Very useful in terms of taking a look at Antler. And when I retired from Greenspring at the end of 2021, they were a $17 billion venture capital firm, so one of the largest venture firms in the world. I met Antler in 2019. I was very impressed with the people that I met, and I was impressed with their business model. I joined in early 2020 as a member of the advisory board, the global advisory board, and shortly after that joined the main board. One of the most important things in assessing early stage companies is evaluating the quality and the capabilities of the founding team. And I think that Antler does an exceptional job of doing that. Why? It's the process. One, they do an exceptionally great job of scouting out capable, aspirational, visionary founders to get them to apply to the Antler program. And only a select few of those, like 3% of them, are accepted to come into the program. And within the program, then they're matching people together, testing ideas, and creating companies. So Antler actually is a company creation entity as opposed to investing in a company that's pre-existing. And then from those that they take a look at, they call it even further to those few firms that they actually invest in. Then they provide a tremendous amount of follow-on support to help grow those companies. It's a process that's very programmatic, it's very repeatable, it's very measurable. And importantly, I think it's gotten better over the years as Antler has grown. They're getting higher and higher quality individuals. So from my position, I think you should take a look at Antler as a very safe and capable pair of hands to help accentuate the entrepreneurial ecosystem here in New Mexico.
Thanks, Todd. Good morning, Council. It's a privilege and an honor to be here and present to you guys today. My name is Tyler Norwood. I'm the managing partner of Antler Operations here in the U.S. I oversee all of our operations and the programs that you heard about. I also oversee all of our fund operations. I'm the lead of our investment committee on all of the investments that we make here in the U.S. I was part of the original co-founding team of Antler all the way back in 2017. I had the opportunity to move back to the United States in 2019 and lead the expansion of our mission here in the U.S. And as Todd and Amy and Chris have all discussed, really the passion for what we're doing comes from the background that all of us as a co-founding team have as entrepreneurs ourselves, and seeing the tremendous impact on growth, on productivity, a lot of things that we discussed in this previous presentation that was given, job creation, and being an entrepreneur myself, seeing that firsthand, I was very passionate to be invited to join the co-founding team of Antler at the very beginning, and specifically to work on building a fund whose focus was not to simply invest additional capital into the existing companies out there in the market, but to actually build infrastructure to help new companies come to market at a faster rate. And we've had the opportunity to spend the last 6 months with Chris and his team, learn a lot about the New Mexico ecosystem. And I'll end with saying we couldn't be more excited about the opportunity to be here. We think that New Mexico fits very squarely into our strategy to bring the access and the infrastructure and the funding to a more diverse set of founders across the United States, to help more people choose entrepreneurship as a career choice, to help more private companies be started, to create more economic growth, and more job creation. And it's an honor to be here, and we're very excited about the opportunity to potentially work with the state of New Mexico. I'll pass it over to my colleague and partner, Ryan Somerville.
Thanks, Tyler. Morning, everyone. Thanks for having us. Ryan Somerville, general partner with Antler, based out of Boulder. I've spent my career in kind of economic development and entrepreneurship, and Antler really sits at the intersection of those two things, as we've alluded to. We've spent the last several years building this global infrastructure in terms of a knowledge base and infrastructure across the world, and I think importantly a network to help support early stage founders to become entrepreneurs. So we're really working with folks, to Chris's earlier point, that are potentially leaving their job that would otherwise be locked up at a corporation, or potentially working on something by themselves in a local coffee shop in their attic or whatever it might be. We're really helping provide a platform for those individuals to create the ventures of tomorrow. And intentionally doing it outside of Silicon Valley is an important part of our story. We initially launched the U.S. presence in New York. We moved on to Austin, our second location, and now, as I referenced, I'm based in Boulder, Colorado. We have a larger strategy I think is important to note, which is that talent is fairly evenly distributed, but opportunity and especially capital is not. So we're trying to bring capital, resources, and education to these markets outside of the traditional hubs to be able to spur on economic development in those regions. Any questions?
We appreciate you all being here with us today. Questions for our folks, our consultants, or the Antler representatives?
Madam Chair.
Go right ahead, Treasurer.
I was reading the material. So the primary base is Singapore? Is that correct?
The primary HQ of Antler as a whole entity is based in Singapore. We have our dedicated entity here in the United States. Our funds are based here in the United States. All of our team here in the United States are employed out of our entity here in the United States as a subsidiary of the Singapore entity. But all of our operations in the U.S. are specifically focused here on
and perhaps important to note, this fund is exclusively investing into companies in the United States.
And my second question is, I noticed that Mr. Grimlin owns 40% and an additional 15% via affiliated vehicles. How does that work for you all, that he has the majority, and how would that make sure to strengthen us or make us feel confident in the direction of Antler?
So the ownership of Antler is an entire corporate entity, as we stated with Mr. Grimlin. The way Antler works as a subsidiary and a family of funds is myself and my team have our economics here in the U.S. operations and the activity of the U.S. fund. So our team is incentivized and specifically focused on building a successful portfolio of investments here in the United States, and our economics are reflected in that structure.
And I noticed that there was a plan for there to be a New Mexico office, I believe in Santa Fe. When and how many employees would that consist of?
Yeah, so I think that there's a sequence of events that's important to note here. So the initial step is that we're going to hire a full-time principal based in New Mexico, potentially Albuquerque, potentially Santa Fe. We already have this individual identified. And then over time, as we build a critical mass of portfolio companies, we'll take incremental steps to open up a formal office and then potentially consider running programs here. But there's a really important point to clarify here, which is that we have these 3 regional hubs in Boulder, Austin, and New York. The intention is to work with local New Mexico startups to come to our 8-week programs in these existing locations. We actually pay a relocation stipend in addition to help them do this. They would work over the course of the 8 weeks in the program, validating their business model, getting initial traction, and the intention is they would return to New Mexico and build up what would be that critical mass that I referenced formerly.
And this scout will be basically working across the state to identify promising founders that want to apply to this program. And so they'll be, going around the state at companies, universities, the national labs, trying to find people that are interested in going down the entrepreneurial path and want to apply to Antler to have that helping hand to start that process.
Thank you, Madam Chair.
Thank you, Madam Chair. So if you are successful with the $40 million, then and deploying that at $750,000 per investment, so we should think about you potentially investing in up to 50 New Mexico startups over the course of the fund. Is that
we're investing in their only in their early stage U.S. fund. They also have a $285 million Antler Elevate fund that will provide follow-on capital at the blanking here at the Series A, seed through Series C stage. So this fund will be more focused on pre-seed and seed, but that Elevate fund, in addition, will be investing in companies as they go up the pyramid, basically.
Okay, so that would sort of be the cost to be invested in.
Yeah.
So you may wind up with fewer companies.
If you look at
page
208, there's some assumptions in there about how that works in terms of the fund that we're investing in, plus Antler Elevate, which has already been raised and will benefit the ecosystem. So the math is there, and they're pretty, we think it's pretty conservative. I think, you may want to speak to this, the Antler team, is when you go into new ecosystems, sometimes, you're generally pleasantly surprised that there's pent-up demand for this type of opportunity for kind of underserved kind of communities in terms of having the opportunity to apply to these programs.
Yeah. In terms of the cost to invest, so the specific team sitting here in front of you, our focus is on helping new companies come to life. You can see here in the chart in the presentation that if you look at the amount of capital that's attracted into a new ecosystem by the creation of those new companies, it's actually quite substantial. So if you look at survival rates of early stage companies, as you get down into the growth stages, you look at a Series B or Series C investment into one single company started here in New Mexico is potentially larger than this entire investment. Secondly, we obviously have Elevate, which is our own internal Antler follow-on vehicle. We work very closely with that team to continue to invest at the Series A and beyond, as well as an extensive network of downstream relationships we have with venture capital funds across the country. So as we help start new companies here in New Mexico, those companies will obviously be introduced to all of the different funds that we know across the United States. Lastly, I think what's unique about Antler in terms of working here in New Mexico is the global portfolio of companies we have. So all of our sister funds around the world invest in lots of companies, and the most successful of those companies will almost always, at some point in their growth stage, pursue expansion into the United States. We plan on making New Mexico a state that we talk about, a state that we would love to continue to work with the Economic Development Council to introduce as a potential place for these companies to relocate as they come into the United States. So that's a separate from our fund activity, sort of extra bonus for cost to invest, is to continue to highlight New Mexico as a place for foreign companies coming into the United States to consider as a location of their U.S. home.
Thank you.
Thank you for the question.
Anything further?
I have one more question, Madam Chair.
Yeah, Madam Chair.
When we talk about how many investments were in the portfolio versus how many have been fully written off and how many were held at cost, what have you learned from that lesson to try to change those numbers or improve them?
For Fund 1, we're actually on target in terms of fund performance. So we came within a 5% margin of error, the number of investments that we plan to make in that fund. Our write-offs and failure rates are exactly on target with the original models that we built, as well as our progression out of the J-curve in terms of markups and portfolio performance is also on target with what we originally modeled. I don't mean for that to come off as everything has gone perfectly correct. We've learned a lot in our operations, as Todd mentioned. We've continued to get better and better in terms of finding and identifying amazing talent across the United States, learning the specific things that they need at different stages of their company to continue supporting them, both during and after our program. So we're very excited about the stage that we're at here in the United States. We're coming to Mexico with 4 years of experience running this under our belts here in the United States. And we're excited to take all those lessons and move forward with our mission, our vision, with hopefully New Mexico as part of that footprint.
And then, Madam Treasurer, I think it's important to note that early stage venture, by nature, has a high loss ratio. So, depending on which statistics you kind of look at, some of the data that I used, it was actually updated recently, but say 2/3 of startups and 50% of capital at the early stage results in losses at a high level. It's pretty normal that companies fail at this stage. It's just a part of the startup activity, and the returns of these venture funds are really dependent on there's a reason they call it the power law, for people compare it to the tennis world where you have 4 major players, or in the case of Serena, they dominate the sport. It's the same in a venture portfolio. A small percentage of 10-20% of the portfolio drives most of the fund returns, and that's entirely normal. It's almost the law of nature, practically the power law, and it's not necessarily a bad thing that a fund like this has an elevated loss ratio relative to some of the other strategies in our portfolio, like buyout, that are don't have that type of risk profile.
Thank you, Madam Chair.
Anything further? We have a motion.
Madam Chair, I just want to say that I particularly appreciate the answer to John's question about the way the fund is structured, because I think the biggest need, I've been watching this for quite some time now, and one of the great needs with startups and venture is follow-on funding. And the fact that they're reserving a portion of their fund for that follow-on funding, I think, is really critically important. So, with that in mind, based on the recommendations of the Council Investment Committee, SIC staff, I move that the State Investment Council approve a commitment of up to $40 million to Antler US Fund 2, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Okay, we have a proper motion by Member Lavender, a second by Member Bingaman. Any discussion on the motion before the council? A roll call vote on the motion.
Commissioner Garcia Richards. Treasurer Montoya.
Yes.
Secretary Props.
Yes.
Member Tejas.
Yes.
Member Allen.
Yes.
Member Bingaman.
Yes.
Member Lavender.
Yes.
Member Messina.
Yes.
Member Summer.
Yes.
The motion
Yeah.
passes 9-0.
Good luck. Good luck.
Thank you.
Do well.
Thank you very much. Thank you very much, Council. We're very excited to work with the state of New Mexico and everyone at this table, and we don't take this lightly. It's a huge responsibility, and we really look forward to bringing to life all the things we've discussed in this paper in the real world. So thank you so much for your vote of confidence, and we look forward to working together. Thank you.
Item 3D, Thayer Ventures.
So we're recommending our second commitment to Thayer Ventures. The last commitment was pre-COVID. It feels like a long time ago. We committed $7.5 million to Thayer's third fund in February 2020. Since then, Thayer is an early stage venture firm with a focus on travel and transportation technology, which, just when I say that out loud, it was a difficult time, I think, to say the least, for that entire ecosystem, where we're all locked up in our rooms. But frankly, we were quite pleased. Mark Farrell in particular has spent a lot of time here really trying to get to know the ecosystem, get to know companies. I think it's a good story to remind ourselves these things take time. He was introduced to RS21 pre-COVID and developed a relationship with them over, 3 years. And just announced recently Thayer's, the fund that we're in, is going to lead a $5 million round with a $3 million check of a company called RS21 that's been a really interesting company that's been bootstrapped out of Albuquerque and is looking to accelerate their growth now that they've gotten to a certain point. And hopefully we're looking for Thayer to help them with their network of strategic investors that they have. In addition to that, they also have a company that we'll tell you about that has moved to New Mexico in the meantime as well, called NoiseAware. But I will pass it along to Amy now. Sorry, Richard.
Thanks, Chris. I'll just give a brief summary and then we'll turn it over to the Thayer Ventures team. So Thayer is an existing relationship. There was a $7.5 million commitment made through the New Mexico program, and they have been active in the New Mexico community, including one investment that Chris talked about that just closed in the last month. And they have moved one of their portfolio companies to the state as well. That was something they talked to us about in the last due diligence as well, something they were going to look to do, and they did it. And the total direct investment is approximately $10 million, with other investors putting in an additional $16 million into these rounds for these companies. And then Thayer's also established an office in Santa Fe, given they're spending a lot of time here. So Thayer's co-founders are Mark Farrell and Chris Hemmeter, who's here with us today. They've been working together for 13 years. The team is supported by one managing director, one vice president, and 2 venture partners. Their strategy focuses on early-stage venture capital investments in technology companies that are focused on the travel and transportation industries. The portfolio is expected to mostly be North America, but they have a secondary focus on Europe as well. I think their focus on the travel and transportation sectors within venture capital has really differentiated them in the industry. They've developed a deep network in the space. They also have strategic investors that have come into the fund that gives them some access to some of the big players in the industry. And they've created an industry advisory board of about 30 members to help identify investment opportunities. And they can use that board to also assist with due diligence and help with portfolio companies. In doing the analysis, the firm does have an uncertain track record, although the most recent fund that you're in is still unrealized. And with venture capital, it really takes just one positive outcome to really move the performance potentially. So it's still out there as an unknown of how that will ultimately perform. And terms on the fund are average compared to other funds in the market for the most part from our analysis. So with that, I'll turn over to the Thayer team.
Thanks, Richard, and thank you, Chris, for the introductions to the council. Privileged to be with you again. Excited to be here. I think as an overview today, I'll spend a quick bit as a refresh on Thayer Ventures as a firm, and then really highlight our New Mexico activity over the past few years, certainly since we were last year back in 2020 with the Investment Council. Again, Thayer Ventures, we are an early stage venture capital fund focused on travel and transportation technology investments. It has been our industry focus since we founded the firm back in 2009, and part of our DNA. It continues to be our area of focus today. This is a huge global market, over 10% of global jobs, 15 trillion in global spend, and the investment landscape with startup opportunities that we see in our ecosystem is massive. We have been a leading investor in this space since 2009. Other investors have come to the space over the last few years as the industry has had more and more capital flow into it. Even with the bump of COVID in the beginning, we've seen a massive uptick in investment over the past few years. But with our early positioning in the industry, we feel we have a strong competitive advantage going forward, having all of the relationships in the industry and our prior track record as well with our investments. Our team has been together, as Chris mentioned, since 2009. My partner, Chris Hemminger, is here with me today. We co-founded the firm together 14 years ago. Our other managing director joined us in 2011, and we have two venture partners on our senior team with us, one that started in 2010, and the most junior person joined us in 2016. So we've been together for a long time, and that continuity has provided a lot of benefits to us as a team, both in terms of our working relationship, but also deal sourcing within the industry. But I think what truly sets us apart, aside from the industry focus, and was alluded to, was our strategic limited partner base that we include the state of New Mexico in. But really, as we think about an industry-focused fund, what we set out to do in the beginning was develop a strategic limited partner base that would be incredibly additive and accretive to our investments. It's individual limited partners in addition to our advisory board, CEOs of many different hotel chains, airline groups that you would have heard of, restaurant groups, but in particular, strategic limited partners that have invested off their balance sheet. This fund that's before you, Thayer Ventures 4, Marriott Hotels Corporation is an investor off the balance sheet, Hyatt Hotels, Hilton Hotels out of this fund, Host Hotels, Resorts and Hotels. Capital One now, a credit card fintech platform that's doing a big play into the travel industry. These are all strategic limited partners that invested with us as obviously as stewards of their capital, but also be strategic partners. And they work with us very closely with our investments, both on the due diligence phase, but also once we do invest, and we're working with this already with our first investment out of Fund 4 in New Mexico. Once we do invest, helping grow that company and into the ecosystem, not only here in New Mexico, but also within the United States and abroad as well. But I think what I really wanted to focus on today was talk to you about our New Mexico activity and what we've been doing since 2020 when we were before you last. I would say that it is what we are really excited about as a firm and why we're really excited to be here with you today. We've been actively looking at deals to invest in inside the state of New Mexico since 2017. That's when Chris and I and our other partners started coming down here. And it obviously starts with one deal, but it has blossomed over time, such that at this point, we average a visit to the state of New Mexico every 6 weeks, so much so that we open up an office here in Santa Fe, which is the second office we've ever opened as a firm. And what we've done is, and Chris mentioned this, we've intended and very purposely to develop relationships, long-term relationships, that would add to deal flow and really create those investment opportunities over time. And as we thought about it, it's relationships within the government, specifically within your economic development department, non-governmental agencies such as chambers of commerce, the State Chamber of Commerce and local ones, educational institutions. We work with the University of New Mexico and their Rainforest Labs quite a bit, co-investors that are based here in the state, and also other co-investors that the SIC is invested in that do activity in the state, and probably most importantly, simply the entrepreneurial community. I think there's no replacement for getting to know entrepreneurs and having a great working relationship with them. In Thayer Ventures 3, which is the fund that you've invested in already, we made two specific investments into the state of New Mexico. The first was Robotic Skies in the drone space. We co-led the Series A investment along with Boeing. Early, we led the Series B investment, continue to be on the board and big supporters of the company. Unfortunately, that company did decide to move out of state for their own logistical reasons, but it really started our investment process here in state. The second one, as Richard mentioned, was a company called NoiseAware. This is a company originally based in Dallas, Texas, and as part of our term sheet to lead their Series A investment, we required them to move to the state of New Mexico. That was something they were very willing to do. Obviously, they signed the term sheet and took our capital to do so. Admittedly, that move took a little bit longer than we wanted to because of COVID and because of some of their healthcare concerns within the company. However, as of last year, so 2022, the company is now headquartered here in New Mexico. Happy to report that in the next month, they're going to be turning cash flow positive and planning all of their hiring here in the state of New Mexico. So an example of some of the things that we're doing within the state directly with the Thayer 3. I think as important was talked about with Antler's intentions as well, that we've been working with our existing portfolio companies that are not direct investments here in the state to also look at operations here in the state of New Mexico, whether it makes sense to bring any type of operations in state. So in particular with Thayer Ventures 3 and our third fund, Lighthouse Hotels is an investment of ours. They're a tech-forward hotel management company. We asked them to look in state, and now they've taken over 2 of the hotels up in Taos, so employed close to 50 people up in Taos. It's not a direct investment, but part of what we believe is our pact with the state of New Mexico to bring additional economic activity to the state when possible. So we're very excited about that. But obviously most excited about our most recent investment, a deal that we closed last month in a company, RS21, based in Albuquerque. This is our first investment in New Mexico out of Thayer Ventures 4, which we're here before you today to seek approval on. RS21 is a AI machine learning based company, bootstrapped by a PhD that came out of the labs over the last 7 years. Just an incredible founder and founding team. Thanks to Chris's original introduction, as Chris mentioned, this took 2 years to gestate in terms of a relationship, developing up a relationship with the board, with the CEO, and now with their other employees. There wasn't an opportunity early on to make an investment, but over the course of time, we got to know the company quite well, believe in that team, believe in what they're doing, and believe that it's going to be a core portfolio company for us in Thayer Ventures 4, not just as an individual investment, but also aiding our additional portfolio companies in the fund and our strategic limited partners. In any case, we made the investment, we closed it last month, so we invested $3 million directly. It's going to be $3 million out of a $5 million investment. To your comment earlier, we've reserved against it. We continue to do so to continue to support our companies, not only in New Mexico, throughout our portfolio, but it's a core part of what we do as a firm. And this is a company that we believe is just the beginning of kind of a relationship set down in Albuquerque surrounding the labs and the PhDs that are coming out of the labs. We're incredibly excited about it. Again, we believe that's going to be a core part of our portfolio in Thayer Ventures 4. We've already introduced them to a number of our strategic investors. They have a core application within the travel ecosystem we think, quite frankly, could transform how hotels and airlines operate. So we're excited to take that to market into our strategic limited partners. But I think in addition, it's not only RS21, but it's the time that we've spent in the state that really has allowed us to develop really a deep pipeline as well of additional investment opportunities to layer on top of RS21. Chris and I are going to go see, after this council meeting, an additional potential portfolio company in Albuquerque just after lunch. So we're excited about the opportunity in front of us and the momentum that we built in state. We think there's a huge landscape in front of us as a firm to invest in state. We're incredibly excited about it and really honored to be in front of you and look forward to hopefully continuing our partnership together. So happy to answer any questions.
Madam Chair. Based on the recommendation of the Council Investment Committee, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $10 million to Thayer Ventures 4 LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and condition, and completion of appropriate paperwork.
I'll second that.
We've got a motion by Member Lavender, motion by Member Bingham, second by Member Lavender. Discussion on the motion before the council. And we'll take a roll call vote on that motion.
Commissioner Garcia Richards.
Yes.
Treasurer Montoya.
Yes.
Secretary Prost.
Yes.
Matei.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Mr. Lavin.
Yes.
Mr. Messina.
Yes.
Mr. Summer.
Yes.
Madam Chair, passes 9-0.
Thank you both for being
Thank
here.
you, everyone. It's an honor. Look forward to working together.
Keep it up.
Right. On to agenda item 3E, Tramway.
Madam Chair, I'll, just want to, I said at the investment committee, I've known, Ms. Tuttle since, for more than 60 years. Her father was the superintendent of schools in Anthony, and my dad was the superintendent of schools in Raton, and we met each other when we were slightly younger. And I've known Ms. Rice for about the last 7 or 8 years, and I met Chris recently. So I know these folks. I have no connection to them other than the fact that I do know them personally.
Thank you, but it's kind of rude to reveal people's age. And I'm a little bit younger. She met you when you were a baby.
She's younger.
Okay.
Take it away. Take it away, Chris.
On that note, let's talk about demographics again. So just, if you're not aware, Tramway Ventures is a local life science fund started by Juanita Tuttle in 2017. But, you know, I think it discounts the fact that Juanita's really been a central figure in the New Mexico ecosystem for a long time. You know, she founded or co-founded 6 companies since, you know, prior to starting Tramway. You know, since starting Tramway, they've invested in 5 local startups. And, you know, when we made the first commitment in 2020, you know, the reason we set up the Emerging Manager Program is we were hoping to create regional leaders in terms of venture capital, you know, similar to what we've seen in other ecosystems, particularly good examples there's good examples in Utah where firms have grown slowly over time with support from their local ecosystem, people like us. And, you know, Tramway's really going along that regard. So we're recommending a commitment of up to $20 million, which is a big increase from the $5 million that we recommended in August 2020. And I think it's reflective of the fact that Juanita has really, you know, come up with a wonderful plan to try to, you know, deal with the fact that, you know, eventually she will be stepping aside and succeeding, and she's brought on 2 new people to help her take over from her at some point down the line. One of which has been Katie, who's been a part of the ecosystem for quite some time, and a new person who came in. His family loved New Mexico and has, you know, moved here and has incredible experience in the life sciences space that I think will be very valuable. So this again is a recommendation to commit up to $20 million, and I think it really reflects the fact that kind of what the aspiration when we set up this program is to try to promote things like Tramway Ventures over time, which is you know, firms that can grow into being institutional, capable of raising larger funds from folks not just like us, and you know, making that journey from a smaller emerging manager to something that can raise a hopefully longer term $100 million fund. Have some on, Richard.
Thanks, Chris. Tramway is an existing manager in the New Mexico program. You actually have exposure to the first 2 funds. The New Mexico program directly made a commitment to Fund 2 for $5 million. And then the New Mexico program also has exposure to Fund 1 through the Catalyst Fund. There was not a direct commitment to the fund for that one. As Chris mentioned, Tramway was founded in 2017 by Juanita Tuttle, and he gave her background briefly. One of the things that when we analyzed this in 2020 is we wanted to see more of a succession plan, more of a broader team that could potentially raise more capital. And we think Juanita's really added 2 really strong people to the team. She's added another managing partner in Katie Rice. We were familiar with Katie because she led the New Mexico office for Epic Ventures, back when there was a requirement to open an office in New Mexico as part of the commitment. And she's got more than 15 years of venture capital experience. And what was great about seeing Katie in the ecosystem was it was more than just Epic's investments in New Mexico. She was quite active in the New Mexico ecosystem, including co-founding a startup company and also founding Ski Lift Pitch, which is an annual event to connect startup companies with investors. And, you know, it's still talked about amongst a lot of the different funds that we meet with out in the marketplace. So that's been a great event. And then Tramway also added a third managing partner with Chris Japp, who has over 30 years of experience in the medical device and life science industry. He's held leadership roles at firms like GE Healthcare, Boston Scientific, Pentax Medical, and Hitachi Medical. And all three managing partners are based in New Mexico. And we think this addresses one of those considerations that we have with the fund. And Juanita, of course, expects to remain active for several years to come. So it's good to see more senior experienced people at the firm as they go forward with Fund 3. And in the past as well, the firm's had 3 venture partners that are very experienced in the industry as well that serve on the investment committee too. So it's more than just 3 opinions. It's actually beyond that. From a strategy standpoint, the fund targets seed and early stage investments in medical technology, biotechnology, and healthcare technology with a strong emphasis on New Mexico, where all the investments have been made to date. But they also look at the Southwest region as well, states like Arizona and Colorado. The firm hopes to use the larger fund size of $40 million to make more company investments, as the prior funds have been fairly concentrated, which can increase the volatility of performance as both the gains and the losses are magnified with a more concentrated portfolio. From a performance standpoint, the prior 2 funds are still developing. In the biotech industry, investments can take years to develop, and realizations could come 6 to 9 years down the road. So it does take some time. And in looking at the fund terms, they're in line with similar funds in the market from our assessment. And with that, I'll turn it over to the Tramway team.
Thank you. Madam Chairman, members of the council, it's a pleasure to be here today. I'd like to start with a short story because I think it tells the New Mexico story a little bit. And imagine that you are walking into a lab. It's kind of located near the pit in Albuquerque, and it's 2009. This lab is working on a technology called magnetic resonance, which you may recognize more clearly as the underlying technology for MRI today in a hospital or a clinic. Well, this team of physicists and engineers has invited me to come to a brainstorming session. So we walk in the door, and what we see are the usual electronic workbenches and some very large magnets. So we sit down and we begin the brainstorming session. It goes on for, half an hour or so, when I noticed something sitting on the corner of the conference table, and it's small. It's about 4 inches by 4 inches. And I said, "What does that do?" And they said, "Oh, well, that's something we invented to identify particles in fluids, like tiny rocks in oil deposits." Well, I perked up with that because human blood is a fluid with particles in it, red cells, white cells, platelets, and when things are not going well, bacteria, which leads to something called sepsis. So that conversation was the beginning of the journey of a startup company that became NanoMR. And I tell that story because it is so typically New Mexico and what we see here all the time, convergence of people in physics and engineering and medicine, really talking about things that improve human health. And put simply, we live in a state where breakthroughs are born, and frequently. So it's an exciting time. In 2017, as Richard mentioned, I was excited about the opportunity to start the first life sciences-focused venture fund in New Mexico. We had a lot of people around us excited about that opportunity. That was Tramway 1, and today we are embracing the challenge of leading from New Mexico and becoming a premier resource for life sciences venture capital in the region. To do that, we need a bigger fund. We're ready for a bigger fund. It will allow us to do more investments and more follow-on investments. Our current portfolio companies in alphabetical order are Armonica, BenaBio, Circular Genomics, Vitazi, and Wavedyne, and they will be joined by an exciting list of other companies. So looking to the future, we have a vision of building Tramway as a firm, as a leader based in New Mexico, but a regional leader. And to do that, we're excited that our original founding investor advisors, which Richard mentioned as well, are with us for Tramway 3, but we have 2 new partners, and I'd like for you to hear from them a little bit for a few minutes. Katie, long experience in venture capital in New Mexico and an entrepreneur herself. And Chris, with deep experience nationally and internationally in our domain areas, medical devices and biotechnology, who has found his forever home here in Santa Fe. There you go, Chris.
Thank you, Anita. Madam Chairman, council members, especially as a new resident of New Mexico, it's a real honor for me to be here today. As Juanita mentioned, after many years of living and working around the world, we've chosen Santa Fe as our forever home. As my wife and I say, we're not moving again, and this is where we want to be. I've had the good fortune to work for many large medtech, biotech, and health tech companies around the world. Over that time, I've probably looked at or either acquired probably north of 100 different startup companies. I think what I found over that time is this kind of advanced technology development that we're looking at in the startup world doesn't take place at the big corporates. It's not what they're geared to do. They tend to go out and acquire companies or partner companies, and that's why this field is so lucrative. And I think what I've also seen, especially over the past year or two, a major revolution taking place in technology in the medical world. Technologies like AI, medical robotics, wearable devices, advanced sensors, advanced diagnostic imaging. It's a major change taking place that I think will impact all of us in a positive way. It's going to start improving patient outcome. It should reduce the cost of medical care around the world, and it should increase access to the disadvantaged to medical care as well. A lot of impact this is going to have. And from an investment standpoint, you know, the good thing about medical technology, healthcare technology, tends to be fairly recession resistant, let's say. It's a good technology to be involved in. Picking the right company can yield to very high return. And right now it's a target-rich environment. There's a tremendous opportunity. And what I've seen here, especially as a newcomer, in New Mexico, we've got a lot of the building blocks to make that a reality. What we need is more investment. We need to start building these companies. And I really believe there's no reason we can't make New Mexico a real hub for medical, biotech, and healthcare technology, similar to a Boston or Bay Area or even choosing a country in Ireland or in Israel or what have you. So I think the opportunity is great. I'm super excited now to be part of the Tramway team and to build this future for the state of New Mexico. Well, thank you very much, Council. With that, I'll turn it over to my colleague, Katie Rice.
Thank you, Chris. Thank you, Juanita. Thank you all for having us here today. I'm Katie Rice. I'm a partner with Tramway Ventures, and I am just thrilled to be here in New Mexico investing in biotech, medtech, and health tech companies with Tramway, with Juanita, who I've known for a long time, and I've admired her as an investor and an entrepreneur for a long time, and with Chris, who brings a wealth of industry expertise to our team. I am not originally from New Mexico, but I like to say I got here as quickly as I could. I'm a transplant not only to New Mexico, but I'm an immigrant. I came here as a child, and I've lived all over the world and all over the U.S., but I've been here for well over a decade, and I have deep roots here now. And I love the state, and I'm very proud to be growing great companies here in my adopted home state of New Mexico. So I do have 15 years of venture capital experience. I've reviewed hundreds of companies. I've worked on dozens of deals, and I'm also a tech entrepreneur myself. I'm the co-founder of BabyPage, a New Mexico-based venture-backed startup. I raised the venture capital funding for BabyPage, and I think that unique combination of experience sitting on the side of the table as a venture capitalist and on the other side as an entrepreneur raising VC funding, I think that's really important perspective for our companies as we grow at Tramway Ventures. I'm also a very active, very proud member of our thriving startup
ecosystem here in New Mexico. I've worn many different hats over the years within our startup community, and I am the founder and creator of the Fearless Pitch, which for 9 years now has brought new investors, often investors coming to New Mexico for the first time. They've come to Taos, and the founders, the New Mexico founders who've had a chance to participate, have all had this unique opportunity to make meaningful connections with those investors. And the team at Tramway, we're very committed to continuing to support and cultivate this very important ecosystem, and including programs such as Fearless Pitch. And we have some new ideas, and we're very excited with Tramway Fund 3 to launch a university venture capital internship program. I've seen this work really, really well in other regions, most notably Utah. And I think it's really important that we give bright college students here in New Mexico an opportunity to gain real-world investment experience, real venture capital experience, so that they have a really great reason to stay in New Mexico or come back to New Mexico and build really great companies here or work as seasoned investment professionals here in New Mexico. So we're really excited to roll this out with Fund 3. We'll start with UNM, and we hope to ultimately involve all 3 of the major universities here in New Mexico. So to wrap up, we are very excited about Tramway Ventures Fund 3. As you know, we are raising a bigger fund. We are raising $40 million. And with that, we will be able to invest in a larger number of health tech, biotech, and med tech startups. And we are reserving more capital for follow-on investment so that the portfolio company is doing well, can ultimately succeed. And then, of course, we are expanding our team and making sure we have the time and resources to cultivate and support that very important startup ecosystem and bring forward new programs, including the University Venture Capital Internship Program. So we are very much looking forward to the future of Tramway Ventures here in New Mexico, and even more importantly, we're looking forward to the future of medtech, health tech, and biotech startups here in New Mexico. Thank you all very much for your time today. We'd love to hear any questions.
That's great to have you. Thank you. Thank you. Questions from council? Yes, Madam Treasurer.
Hello, everyone. I wanted to first make a comment that I'm very happy to see Mrs. Tuttle and get to see you, not in person, but at least to see who you are, because your name precedes you. I think Girls Incorporated should have been celebrating you as one of the inspirational women of New Mexico. So I'm very happy to at least see you on the screen. I do have one question for you. I did read the paperwork that in 2026 you plan to be the partner emeritus role. And I know that part of the contribution today is based on the trust of your name and the work that you've done and the commitment you have to New Mexico. It seems you have a very good team with you, but can you just touch on what controls are in place for this fund when you decide to be the emeritus? And also, I guess that question would go to the partners that, how are you planning on utilizing her expertise and skill set even when she decides to be the emeritus?
Thank you, and thank you for the compliment. Carrie, what we have said is the current plan is that I will transition to partner emeritus after 3 more years, so after 24, 25, and 26 at the beginning of 27. That is not cast in concrete. It just seems like a logical progression. As far as what happens about that time, and one could think forward to thinking about that time, it might be time to be raising money for Tramway 4. We have, in terms of mechanisms for bringing on new partners, because that's a logical time that might happen, to add to the Chris and Katie team. We're creating for the first time an umbrella management company, Tramway Ventures, LLC, that has the structure in place where new members of that management team, who then will become members of new general partners for new funds, will be selected. And the governing board of that group are the 4 original founding members
of Tramway, the 3 venture advisors and me. And what we are empowered to do under that structure is to bring on new members. So that's the mechanism with which that would work. And so obviously the company would be seeking to bring on very seasoned, experienced, New Mexico-focused executives. And hopefully we have a full spectrum that are coming up from that internship program. Actually, they may be coming up to about that time to the associate and principal level. I hope that answers your question.
It does. And I had one more question for Chris. When we're looking at that waterfall structure with no preferred return, can you give me a little bit of guidance on that?
Sorry, can you repeat the question?
I think it's
Chris. Sorry. We have this issue with Chris's.
Yeah, I'll take that. So the distribution waterfall, I mean, what that refers to is how the profits are basically paid between the general partner and the limited partners. With venture capital, it's common that there's no preferred return. Preferred return is basically a return that goes to the investors before the general partner. It's very common in buyout where the hold periods are a little bit more predictable, 3 to 6 years. But with biotech, where the hold periods are uncertain because there's a lot that can happen with a biotech fund, they tend not to have a preferred return.
Thank you, Madam Chair.
We have a motion.
Madam Chair, based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $20 million to Tramway Ventures 3 LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
I will second the motion.
All right, we've got a proper motion by Member Lavender, a second by Member Bingaman and the Treasurer. Any discussion on the motion for the Council? Hearing none, we're going to take a roll call vote on that motion.
Commissioner Garcia Richards.
Yes.
Treasurer Montoya.
Yes.
Secretary Frost.
Yes.
Mr. Thayer.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Mr. Lavender.
Yes.
Mr. Messina.
Yes.
Mr. Summer.
Yes.
Vote passes 9-0.
Very good. Thank you all.
Good luck.
Thank you very much.
Thank you for your comments.
Thank
Get
you.
back to work. All right. So with all of those investments, now we're hearing, I believe, an amendment.
So, yes, we're, as part of the last 2 commitments, we did recommend a little larger size. So we're recommending a change to 3 numbers in the New Mexico policy. Currently, in respect of emerging manager commitments, the way it's set up is the first commitment may not exceed $5 million. Each commitments number 2 and number 3 can be up to $20 million or up to $10 million, and we're recommending that those change to 10, 20, and 20 to accommodate, someone like Tramway being able to raise a larger fund and being able to write larger checks and have a more diversified portfolio.
Point us directly to where those.
Page 198, Madam Chair.
198.
And this is really a clarification of the kinds of policies that we have that are doing what we're doing. But if you look at page 198.
332. I think the.
I'm sorry, you're right.
332.
Sorry about that. Thank you. 198 is mine. I have it in the PDF.
332. The red line.
And it says recommended change to additional investment guidelines.
Any questions on the recommendation before the Council?
Madam Chair, may I ask Chris a question? On the reasoning for the increase, I mean, I know right now there's a lot more money and there's a lot more access, but markets always change. So are you planning on just using that for now, or do you think this is something that we should consistently do or reevaluate if things change? And what have you had recently that made you feel that you needed to increase to a higher amount? Is there a couple that you said, we should have gone to 20 million?
I think it's, a number of factors. First of all, it is an up to, it doesn't necessarily mean that we'll always do 10 million or 20 million. It'll depend on the situation. In the case of Tramway, we recommended 10 million versus the 20 million. In the case of Tramway, I think it also reflects, the type of life science investments they're making are a pretty large percentage of the investments in the ecosystem, and we want to be supportive of that. They've done all the right things. I can't, say enough nice things about how thoughtful Ms. Tuttle's been in terms of planning her succession and bringing on two partner level folks with great experience to help her with that transition. And it also, if they can raise a larger fund, they can lead checks. They have some reserves to follow on into some of their winners. Allows it in some way, so it's kind of inevitably with these things they'll be case specific, but I think it really, in many ways, this is spurred on by Tramway and the progress and effort they've made and how central they are to the ecosystem.
I would say in venture capitalism, especially with the first time that we work with someone, I mean, she's a little different than most. A lot of them are new. This says to exceed 10 million for a new commitment. That's taking a lot more risk overall, but I see where you're coming from. I would just ask you all that if the council approves it, that it don't always go to 10 million unless you really feel like it should, based on the analysis and the evaluation of the staff.
Sure, and I think I've also outlined there are some underlying requirements that are, you have to have a certain amount of investment experience. I believe it's 3 years. So, between that and the diligence that we do together with Mercer's help, it'll be case specific inevitably, and certainly not a guarantee that anybody receives a certain.
Thank you, Madam Chair.
Anything further on the recommendation?
Madam Chair, based on the recommendation of SIC staff, I move the State Investment Council approve the amending of the New Mexico private equity policy under terms memorialized and discussed at today's council meeting. Second.
We have a proper motion and a second. Further discussion on the motion? Roll call vote.
Commissioner Garcia Richard. Treasurer Montoya.
Yes.
Secretary Frost.
Yes.
Mr. Thayer.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Mr. Lavender.
Yes.
Mr. Messina.
Yes.
Mr. Summer.
Yes.
Vote passes 9-0.
Thank you all so much.
Thank you.
Okay, we're going to move to agenda item 3B, which is the last of our investments, and here, New Market, Mr. Lofton.
All right. Thank you, Madam Chair. As you said, we're on section 3G. I think that's page 336 of the materials. With me on this presentation today remotely, I have Mary Bates from Nikita. I have Steve Ezzies from and Molly Whitehouse from New Market. Molly, I see you. I think I see. I saw Steve earlier. Mary, are you with us as well?
I am, yes.
Okay, wonderful. As you can see, they're all remote, so I'm the only one you have to look at today, so I sincerely apologize for that. With that, I'll go ahead with the recommendation. Staff, in consultation with Nikita, recommends a commitment of up to $150 million to New Market International Infrastructure Finance Company, or we'll shorten that to IIFC 4. I'm just going to call it New Market. This is a re-up. SIC, the council committed to $150 million to the prior fund, IIFC3, back in 2021. I'm going to go through and I'll talk about a little bit about the fit for this strategy, and then we can turn it over to Mary at Nikita, and then finally we'll let Stephen and Molly step in to talk a little about their strategy. I know we've all heard in the news and everything. This is sort of the heyday for the private markets. It's it's the private debt or the private debt markets moment or golden age. A lot of different descriptions. There are a number of reasons for that, and one of those many reasons is as we've all heard, the de-risking that's going on in the banking sector. Some of that is on their own balance sheet. Some of that is regulatory driven. This strategy in particular addresses the regulatory driven part of the de-risking. There's two ways that a bank can really de-risk its balance sheet. One, they can outright sell assets, and the council has approved a number of strategies over the past year that we brought for asset-based strategies. So I feel good that we're in a position to take advantage of that. Another way to do that is essentially to gain regulatory capital relief by selling insurance on their potential losses. This is where New Market comes in. So New Market essentially provides that insurance for a specific portion of losses on specifically identified loans. So these loans that a bank would want to do something like this, typically it's in industries where the bank want to maintain a presence. They want to hold on to those loans. They like those loans. They want to develop those relationships. So, and then even more specifically, for within New Market, this strategy tends to focus on infrastructure type loans. So not only are they loans the bank wants to be associated with, but infrastructure, airports, ports, things like that. These are the type loans that the community is large, governments is large in general. They want to keep in place. They want to keep these assets operating and going. So when we go back to the priorities for fixed income that we set out in our structure study, there are many, some of the characteristics that help fit for this for fixed income in general. One, broad collateral diversification. Two, yield and income is the primary driver for this strategy. And then finally, and really most importantly from a fixed income standpoint, downside protection. So in a lot of ways, we find this strategy is a good fit. We want to maintain exposure to this strategy as we re-up from Fund 3 to Fund 4. Just real quickly, before I turn it over to Mary, the fund is targeting a net IRR of 9 to 12%. As I said, it's expected to deliver most of that return through yield and income, and it's going to go in the subcategory of private markets fixed income that we call the diversifying subcategory. So with that, I'll turn it over to you, Mary.
Great. Thank you, Tom. New Market has been active in the regulatory capital relief or significant risk transfer, also known as the SRT market, for over a decade, executing strategies in excess of $35 billion in such transactions as a standalone entity and formerly as part of the Mariner Investment Group. The firm currently manages approximately $2 billion of assets. As Tom has already referenced, New Mexico is a current investor with New Market in IIF3, which stands for the International Infrastructure Finance Company. Today, again, we're discussing a re-up for this manager. What differentiates New Market's offering relative to other participants in the SRT market is their focus predominantly on infrastructure and project finance collateral. Other key highlights with respect to this strategy are the underlying collateral pool diversification, which typically are 50 to 350 loans. The fact that these are senior secured facilities with contractual protections for the lenders. This strategy gets New Mexico exposure to long duration assets with a relatively short hold period relative to the underlying assets. So typically a 3 to 5 year hold period with assets that have, in some cases, useful average lives ranging from 10 years to, in some cases, over 50 years. The banks that New Market engages in their SRT transactions with are some of the largest lenders in the country, or in the world, excuse me. This is a global strategy, important to highlight. There's a high level of current income, approximately 10.5% as it relates to IAFC3. These are typically floating rate assets, and that equates to approximately a premium of 200 basis points over unlevered infrastructure debt. This is a mix of floating and fixed rate exposure. This is predominantly a strategy that focuses on the highest developed countries. Roughly 90% is in OECD countries. And importantly, there is no fund level leverage with this strategy. I'd like to briefly transition and highlight the key strengths and some of the concerns and mitigants as we identify it with respect to this strategy. As we've already alluded to, one of the key strengths that we identify with this opportunity is IAFC's focus on real assets. There really are very few competitors that New Market has for this, and why that's important is that allows the manager to negotiate bilaterally and exert significant control as it relates to collateral selection, pricing, and documentation. We've also alluded to the fact, and Thomas highlighted, that one of the key benefits for New Mexico is the collateral diversification that this strategy offers. It also offers the ability to access difficult to access strategies, some of which are inflation protected. There also has been a low default rate and a high recovery rate associated with these assets. I've already mentioned the fact that you're able to get exposure to long dated assets through a shorter dated, typically 3 to 5 year transaction. On the concern side, we highlight a number in the memo. The two that I would highlight and draw the attention of the committee to are the inconsistencies of the return. As Tom has alluded to, the strategy is targeting 9 to 12% net. The first fund did not meet that return objective, and Fund 3 is currently below that. From a mitigant perspective, we recognize that Fund 1 was largely driven by how fees were charged. So fees were charged in Fund 1 on a committed basis. They've addressed that and now charged on an invested basis. So we think that's an important change and something that gives us quite a bit we strongly prefer that. Obviously, that's more LP friendly. We would highlight with respect to Fund 3, while it's below its expected return, we believe it's tracking to meet the expected return. I'll let Molly address this in greater detail if she chooses to, but a lot of that has to do with when capital was deployed and how that ties to the coupon and the return that's associated with that portfolio. But we are comfortable that that fund should hit its performance target. The other thing that we do have a concern around is that there is a low GP commitment to this fund relative certainly to other to private credit funds in general. We recognize a lot of that does have to do with the fact that this is still a relatively new firm. This entity spun out from Mariner in 2020, and a lot of the realizations associated with preceding funds, which is going to be the basis, as the manager has alluded to, in terms of their commitments have not yet been realized, but they have committed, they verbally committed to increasing that commitment over time. So we do believe that there should be a stronger alignment of interest with respect to that. With that, I'm happy to take questions or turn it over to the manager, whatever would be preferred.
And actually, I'm going to ask you, Ms. Whitehouse, when you make your comments, if you would just touch on those two concerns that were raised.
I'm happy to jump in and comment if that would be useful. It's nice to meet you all. I'm sorry that it's remotely, but it's a pleasure to be seeing you and to be here. So thank you so much for taking the time. I am a managing director and one of the co-founders of New Market and of the IFC strategy. I've been focused on this strategy since its founding. We really started kicking it off in 2012, so well over a decade now, when the risk transfer industry was quite nascent. So we've been growing the strategy over that period of time and have now taken exposure to over 40 billion in assets through the risk transfer strategy. Mary gave a lot of nice statistics about the firm, so I won't bore you with repeating them, but thank you. And have now fully invested our third fund in the IFC strategy, which was, including sidecar vehicles, about 1.4 billion. We had about 1.1 in the fund and about 300 million in some sidecar and co-invest overflow vehicles. As they mentioned, we've been really focused on infrastructure assets, on downside protection, and on finding these interesting kind of arbitrage opportunities within the regulatory capital strategy. And so I'll just turn a little bit to some of Mary's comments. I would note that the prior funds began investing in a negative rate environment. All of our investments are on a floating rate basis. I think that in general, this provides a lot of upside for our investors in terms of where rates are going, and no one really has a crystal ball there. In some instances, we were able to negotiate a zero floor, so we didn't always suffer the negative rate environment. But the prior three funds actually had a target of 8 to 10%. And so a slightly lower target based on the structure of those investments. And we've increased the target based on, well, one, the overall pricing in risk transfer has widened, and also the base rates have widened. So I think that that widening is appropriate, and we should well be able to make it. As Mary mentioned, Fund 3 is on track to meet its net return target. I actually think, and again, crystal ball on base rates and FX and credit, but there's, and if you kind of just look at where the forward curves are, there's a strong opportunity that will actually outperform the 8 to 10 net target for Fund 3. And it's just a little bit of an IRR function. We invested much of the fund in the back half of 2022. And so some of those investments just haven't had as much time to work through the IRR mechanic. And actually, when we started investing the fund in our first investment was the end of 2020. At that point, actually rates were negative. But looking forward, I have a lot of confidence that we'll be able to meet or actually exceed the net return target that we had for Fund 3. And the market environment in terms of Fund 4 is just excellent. I would say that it's even stronger than where we were for Fund 3. So, what we've been able to deliver for New Mexico and for our other investors is really a very consistent set of returns, very consistent cash flows, very good downside protection. One of our investors told me that we were his sleep at night strategy, which I found comforting, especially given a relatively, I think, high and stable net return target. Being able to deliver a 10% on net basis with highly regular cash flows. Maybe also just to comment on the low GP commitment, I would say that we are, in general, a fairly young team. And while we've all been working within the securitization industry and with doing these, we've been really dedicated to this strategy. Most of the senior management has been with the strategy for a long time, and we have not had any realizations from the strategy due to one sort of very long dated investment that we had made in the first fund. So I would say that across the funds, we probably have about $1.5 million invested as a management team. I would say that it means a lot to us. It feels like a lot to us personally. I do realize that based on the size of the fund, it's lower than we'd like to see. It's something would really like to increase, but we haven't like structured that with debt or anything like that. That's all coming directly out of the management team. So definitely something that we'd aim to grow over time. But I think also that the scale of the investments that we've been able to make and the scale of the funds that we've been able to raise is also really a very strong differentiator. We're doing bilateral tickets where we're negotiating 100 to 200 million regularly investments with the largest banks around the world, and being able to invest at that kind of scale with the team that we do, and to be able to deliver the types of returns and consistency that we have is something that I'm definitely proud of and looking forward to building on in the future. So thank you very much to Mary and Tom for all the time that you've spent with us already. I'm looking forward to spending more time in the future, and certainly happy to answer any additional questions.
Great, thank you so much, and we'll go to council.
Madam Chair, I have a few questions.
Please.
Madam Treasurer.
So the current one was expected 8 to 10, and it's not there yet, expected to potentially get there. This one's from 9 to 12. How do I feel confident that you'll get there? And with the preferred return, why did we do that if we didn't hit the target on this last one?
Well, there are a few different, again, I think that the timing is really just the issue for Fund 3. And Fund 3, we started raising in 2020. It had a very different rates environment, and also a slightly tighter environment in terms of the pricing within our industry. That pricing has substantially widened. Our more recent investments will have a wider pricing. Everything we're seeing in our pipeline has a wider pricing. In addition to, our weighted average run rate on base rates is 3.91% right now, versus when we were raising the fund, LIBOR was basically zero and Euribor was negative. And so as the kind of the market has evolved and as base rates have evolved, we should be able to well meet that higher target, especially given that the current fund, I think, should easily outpace the 8 to 10. And actually, based on the fact that it had a target of 8 to 10, once we saw that the projections were going to be well beyond that, we started focusing on structuring the deals more towards like downside protection rather than necessarily pushing towards additional pricing. So, I feel pretty confident in being able to hit it. In terms of the hurdle rates, the hurdle rate for Fund 3 was actually a little bit lower than what we've discussed here. Tom and Mary have beat us up over fees and preferred returns and hurdles. But I think in either for both Fund 4 and for Fund 3, we should still be on a net basis well in excess of the hurdles.
Let me go to organization and legal issues, in particular with the transfer from, I think it's called Mariner, to where you currently are. Can you give me some insight as to, and when I say your organizational aspects of it, I mean that it mentions there's 20 professionals, but there's not an IT staff on board, and there's 2 of your 12 investment folks that are either leaving or have left for this year. So tell me how you are structuring things to be confident that you can continue in progression on the.
Well, I think it's important to note that when we were at Mariner, we were a fully dedicated investment team. Mariner only provided certain back office, IT, and marketing resources even during our time with Mariner, we actually transitioned our back office support to a different entity. So by the time we did the spin out, which was based on a contract that we already had in place with them, the option to do that, we had, maybe not a huge amount, still relying on that. In terms of a dedicated IT professional, we can go into it in a lot more detail, but I actually found at Mariner they had in-house, and I find we have a third-party IT professional group. I'd be happy to talk about that in more detail, but I find it very useful. We have a very international platform, and we're regularly traveling internationally. So when we had IT that only sat in New York and only came online at 9 a.m. New York, that was actually a pretty big problem for us as a team. Mariner had a much more dedicated, US focus, and we're traveling quite regularly. So having a third party with IT professionals around the world who are online 24/7 is really a much better structure for our business model. In terms of the two people who have left, one of them was a credit professional who we've replaced quite imminently. It was an amicable separation, but I feel very good about the new hire and where we've replaced there. And another was a junior associate who we knew for some time had been planning to rotate off. She had a preference of living in London, and we don't currently have a London office. And so we already had planned for analyst hires to train up, and we've had 2 new analysts join over the summer. So, in general, I would say that we've had a very stable set of our team. The senior management has been with the team for a very long time. Steve, who has been quiet, but has been actually working on our strategy since the very early days at Mariner, and then came over to join at Newmarket. Many of us have been working together for a decade plus, and many of the senior credit people have also been on the team for an extended period of time. So my sort of sense.
Thank you.
Yeah.
Thank you, Madam Chair.
Anything further?
And Madam Treasurer, if we could just clarify one point with respect to the fee, just as just to make sure that it's clear. The fees that are in the Makita memo are the standard fees for the commingled fund. We also did, and kudos to Tom for leading this effort, negotiate preferred economics for New Mexico, which are below those. So I don't know, Tom, if you want to highlight those specifically.
Well, from my standpoint, this being a public meeting,
absolutely. I apologize.
Yeah.
Apologies.
Thank you, Tom.
Okay.
Yeah. Thank you, Tom.
You're welcome, Steve. But yes, and I'm not sure if the final economics are in the materials or not. But I'm happy to share those afterwards. And I would just say that on every one of the standard pricing points that Newmarket made a very good attempt to meet New Mexico where we thought there was value.
Thank you.
Madam Chair, I'll make a motion. Based on the recommendations of the Council Investment Committee, Consultant Makita, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council could approve a commitment of up to $150 million to Newmarket International Infrastructure Finance Company 4, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I'll second.
Okay, we have a proper motion from Member Bingaman, second from Member Lavender. Any discussion on the motion before the council? None. We will take a roll call vote on that motion.
Commissioner Garcia Richards.
Yes.
Treasurer Montoya.
Yes.
Secretary Frost.
Yes.
Mr. Thayer.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Mr. Lavender.
Yes.
Mr. Messina.
Yes.
Mr. Summer.
Yes. Yes.
Motion passes 9-0.
Very good. Thank you to folks on with us from Newmarket and Mosqueda, and thank you to Mr. Lawson.
Thank you.
All right, so I know it's past noon, y'all, but we have a few more items, including one more voting item. We're first going to hear on agenda item 4A from our chair of the audit committee. Do you have something to share with us, Member Thayer? Member Thayer?
I think it's beautiful. You're muted, Nick. That's the way.
Is it my turn?
Oh, there he is. There he is. You got it.
Okay. Hang on one second.
Can we come back to you? That's fine.
Yeah, if you could come back to me, that would be great.
So if I could have Mr. Shipp just combine B and C, talk about your report, and then the lease.
Sure,
together.
I'm happy to do that, and I can kind of fill in on the audit committee report.
Okay.
That's fine.
A, B, and C.
If Nick is okay with it. We had an audit committee meeting on Friday. Nick was the only council member there. Our advisory member, Mike Everett, was out of town on a cruise and was unavailable, but we proceeded. We did have our audit firm representatives there, both Corey Hogan and Mr. Hamilton, Aaron, and we think that went pretty well. I always like to tell the council at this time of the year, it's kind of an interesting time for the accounting department, and I want to share it with you again, if I may. We have basically 3 years or 3 balls up in the air at once right now. Fiscal year 23, which we had the audit committee meeting on, and they're getting ready to complete the audit, which is due I guess it's the Wednesday before Thanksgiving. We have fiscal year 24, the fiscal year that we just rolled into. I've provided information as far as the budget schedule for the period ending July, as well as the investment holdings report at the end of July for fiscal year 24. And then we have the fiscal year 25 appropriation request, which we're getting ready to submit as of the beginning of September. So it's always funny, people ask me, well, are you excited that the fiscal year just ended? You know, thinking that everything is over with that. It's just beginning to a large extent. Auditors are focused on completing all their field work, and I think this is the 6th year that the audit firm has been on the audit and are really knowledgeable, and we enjoy working with them. I should point out, as part of the audit committee, it was discussed that we will be going out to bid in the early part of this next calendar year for 2 more years. They can max out at 8, so potentially they can do another 2 years as the audit is concerned. Other than that, on page, I guess, do this if I may. On page 430, I did include the summary for the budget schedule for fiscal year 24. I'm not anticipating any budget problems through the end of the fiscal year, but just bear in mind this schedule is through the end of July. Only 1 month of the fiscal year is presented, month that just passed. So keep that in mind, but I think we're going to be in good shape as far as the budget through the end of the fiscal year. On the investment holdings report, the total on page 436, and I'm not going to refer there because I presume you guys have the material in front of you. You'll note that there's $45.1 billion in assets as of the end of July. That's a fair amount, and I just want to let the council know that we're going to be quickly approaching $50 billion, and you might say, well, how can you be so sure of that? As of yesterday, we had coming in $625 million, including $100 million, or I guess it was $100 million to the Water Trust Fund, $475 million to the severance tax permanent fund, and another $50 million to the conservation legacy permanent fund. As far as I know, and I checked before the meeting today, if all those transfers went through, and they did. But to add on to that $625 million, which was in process yesterday, we're expecting at the end of this month or on the 30th, which is tomorrow, another $2.073 billion coming into the Early Childhood Education and Care Fund, and that's another transfer that we're really keeping our eye on. I know during the audit committee, we got some inquiries about these transfers and controls on the transfers and how carefully we're watching the transfers to make sure that they get done right. And all I can tell you to that is, and I've told my staff, and I feel very responsible for the transactions that take place. These are, if you get them wrong, career-ending transfers. So we make sure that we're really on top of those. But just bear in mind that they are coming in, and we're quickly approaching $50 billion. And then lastly, on the...
To that point, they did go through yesterday, and we're ready for the transfer tomorrow. I do want to thank, this takes a huge team effort. So I really want to thank SIC and DFA because it's a triangle. DFA sends some of their portion to SIC. We have to work with DFA on our end to make sure that everything's done correctly. And then we have to check in with SIC, and we've got to have a staff meeting with SIC, and our team was very grateful to be able to have that partnership. And so these are huge transfers, and it actually takes a lot of effort and initiative and timing for us to all be on the same page. So great team effort on both of your guys' team's part as well. Thank you.
Yeah, and I'm glad you brought that up, Treasurer. Her office has been really great to deal with. She's been proactive. We had a Zoom call last week. There were some questions on both sides of the fence, and got together on a call and ironed it out. Also wanted to point out that one of her staff members, J.R. Rail, is working on setting up a meeting with the AG's office. We have some incoming transfer amounts related to the opioid settlement fund that have not yet happened. And I have to say, in the years that I've been here, and I'm approaching 12, I don't think I've had a staff on her end that is as proactive as they are, and I truly appreciate that. We just have not ever experienced that. So hats off to your staff. And then finally, on the fiscal year 25 appropriation request, I just want to note that the overall increase over the prior fiscal year is about 10%. Most of that's related to the management fees. They comprise about 9.6% over the prior year. We are expecting to try to add an additional 6 people to the authorized headcount of 31, which would take us to 37. So in the payroll side of that appropriation request, it's about a 21% increase. And then on the 400s, which is everything else outside of management fees and payroll, it's about a 13.5% increase. We're expecting over the next year or so to be enhancing some of our IT systems and backups, and we've added some additional dollars there. And then finally, within the material on pages 477 and 478, there is some information on a satellite office in Albuquerque that we've researched. We feel very good in presenting to the council. I should give at least some recognition to State Controller Mark Melhoff. He helped me get some of the questions answered that I needed answered. I think some of the things that DFA has done to both retain and attract staff includes opening up satellite offices that make that a little bit easier. We're looking at basically adding less than 2,000 foot of usable space. It's going to be kind of a hoteling arrangement. People are limited to about 2 days a week. The space is right off of Alameda and I-25, which is very convenient to the people in the Albuquerque metro area. It doesn't favor one group over another. I live in the far northeast heights. We have people in Rio Rancho. We have people in Bernalillo. We think that this is the way to go to help us in the future. I know Vince was talking to someone recently about coming to work with us, and she didn't want to make the drive 5 days a week. I think providing some relief to staff will help us in the future. It's a fairly nominal amount, less than $50,000 a year, and then we're going to have to add some furniture and other things, copying machine, but we feel like this is a good way to head. Just realize that this is a hoteling arrangement. It's not a fully staffed office like the current office, but it will provide us some flexibility and ability to work in Albuquerque a couple days a week for those people driving. So that's all I had, unless there's questions.
Thank you. And before I take a motion on that, Lise, I'm going to ask Member Chase if he has anything to add on the audit committee meeting.
Yeah, I apologize, Madam Chair. I have stuff at work blowing up. So I was in the middle of a call between the county and things at the college. Anyway, Brett, did you cover the audit committee entrance?
I did, Member Thayer.
Okay, good. Yeah, just to go over a couple things, we did meet with Corey Hogan and Aaron Hamilton on Monday to talk about the entrance committee or the entrance conference of the audit, and there's just a new accounting pronouncement that we covered. We went over the audit timeline, and the exit conference will be held in November. And we really need another member on the audit committee. I was the only person there on Monday. We have an advisory member, Mike Everett, who joins us, but he was unable to be there at the time. So anyone that would like to sit and discuss the investment holding report and a lot of other really useful material that Brent puts together and his team, it's really important. Our auditors, I think,
Really selling that position there.
our auditors would like to see a good, healthy participation from our council members. So please reach out to me or Brent if you can join us. Thank you.
Yeah, and further to his comment, there's only 3 to 4 audit committee meetings a year. It's not 10 like the council. So if anybody's interested, it's not a super hard commitment, and we're happy to have anybody that wants to volunteer.
Great. So members, please take note, and we thank Member Thayer for serving in that role.
Absolutely. It's good to have someone that has financial experience, and he has it. So, and he's seeing some of the things we're seeing as far as new pronouncements, and he's dealing with auditors like we are, so it's very helpful to have that.
Any further questions for Brent before we take a motion on the is there a motion?
Sure, Nick, you want to make that motion, Nick? Do you want me to do it here from the floor?
Yeah, go ahead and do it if you could help me out with that.
Okay.
Thank you.
Based on the recommendation of SIC staff, I move that the State Investment Council approve satellite office in Albuquerque lease under terms memorialized and discussed at today's council meeting.
Second.
Second.
Okay, we've got a motion from Member Lavender and a second from Member Thayer. Any discussion on the motion? Roll call vote on the motion, please.
Commissioner Garcia Richards.
Yes.
Treasurer Montoya.
Yes.
Secretary Frost.
Yeah.
Member Thayer.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Mr. Lavender.
Yes.
Mr. Messina.
Yes.
Mr. Summit.
Yes.
Passes 9-0.
Okay, very good. Now we're going to move on to agenda item 5A, any old or new business before the council. And I presume that Starla will be at our September meeting, so we have a chance to give our well wishes then?
She will, yep.
Good. Hearing no further business, we'll go to announcement of the next SIC meeting is going to be Tuesday, September 26th in Santa Fe. I believe with the Zoom option.
And, do we have any public comment to be read for this?
Madam Chair, we do not.
Okay, and with that, we'll take a motion to adjourn.
So move.
Motion to adjourn,
Second.
second, and I'm not going to take any objections to that.
Have a wonderful day, everyone.
Thanks,
Take care.
everybody.